of our top-notch physical and online program in the last 10 years. That's right, we have been impacting the industry for 10 years and have supported about 2,500 professionals in that time space. Register with New Frontiers Learning today.
اسمع بكرة.
Good morning, everyone. Just want to quickly share my screen.
Yes, we can, but it is not on full screen.
Okay, let me stop sharing now.
Yes, you can see
Yes,
it now.
much better. Thank you.
Okay. Yeah. Good morning, everyone. Some people may be coming from different time zones, so good afternoon. Just before we start, I would like to know where our background and what experience you have with CFA, just so that I can know if people have other finance background or if you're just totally new to finance. So if in the chat box, if you can just um, let me know what experience you have or what your background is, like you studied accounting or you're in finance, and where you are in the exam preparation. So if you registered for the exam or you're still considering, please put it in the chat box. If you don't want everybody to see, you can just send it to me. But I think it will be useful for everyone to see. We have 22 people here, so 18 if you remove the administrators. So let's know. Also, please let me know um, where you are in the CFA exam preparation. Have you registered? Are you still considering? And if you just also like to let us know what are you hoping to gain with this course? Is it just general knowledge, or you're actually preparing, just so that we can be sure that we are meeting your expectations? Come on, people. Okay. So, a little about me while I wait for your responses to come up. A little about me. I My name is Joy Olisa. I wrote the CFA exams between 2018 and 2020. So I wrote the last level in the COVID year, as well, that's 2020. That was December 2020, I wrote CFA level 3, and that was the year qualified. By God's grace, because it's not just by my own power. I actually wrote the CFA levels um, and passed that all at one sittings. I've been teaching financial statement analysis for I think 2 years now with New Frontiers. And CFA has actually helped me to change jobs. I was working in audit, and with that I was able to move from being an auditor to working in um, strategy and transactions. So yeah, that's all about my CFA journey. So let me just read the comments that have come in. Okay, so I see Anu has taken short courses on financial modeling and valuation finance background, registered for level 1. Eric, energy sales planning, I got an idea, not yet registered. Good. Olamide studied economics. Okay. Attempted in 2017, registered to write in May. Okay, and is preparing to apply for CFE scholarship. Wanaka is studying for me, so we have a few people that are studying for me. Moi completely new to finance. Okay, very important for me to know that. Expanding strategic perspective. Yusuf, investments analyst considering registering. Moi, sorry, non-finance background. Good, 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 good. And investment research analyst. Okay. Isn't it completely new to finance? Okay. Kiriana, finance background, not registered yet. And Solomon, finance background, preparing for May 25. Okay, we have a mix of people who know finance and people who will know finance. Um, so, um, so I'm going to start now, and if you have any questions, please put it in the chat box, and I will just look at it once in a while to see the comments that are coming in. If you want anything to be particularly addressed, please, that's why we're here. So just put it in the chat box, and we'll respond to it. If you even have any question about studying for CFA and all of that, please just put it together, and I will handle some of those questions with a little time towards the end. Mid-noon, we'll have a little break of about 15 minutes because 4 hours is a stretch. Just sit. So, rest assured, we'll have a 15 minutes break mid-noon. Okay. Solar studied accounting, but yet to register for it. Okay. So, back to my screen. So today, most of what we're going to cover will be in 4 parts: financial reports, income statement, balance sheet. Sorry if you see I'm looking at you from the camera, it's because I have multiple screens. We're going to be considering looking at financial reports. Is this still full screen? Just to check.
Yes, ma'am. It's full
It's still
screen.
full screen. Okay. So we're going to look at it, the 4 major parts: financial reports, income statements, balance sheet, and financial analysis. So let's look at financial reports first. So if you've ever seen financial reports of a company, it's divided into two parts: financial statements, the main financial statements, and other supplemental disclosures that are necessary to access a company's financial position and periodic financial performance. So even I was doing some other research today, and this what you call other supplemental disclosure. Some people call it narratives, or like it just gives you color about what the company does, and a lot of that is also regulatory. You have the main financial statement, which is the income statement, the balance sheet, statement of equity, the cash flow. You have those main ones, and then you have supplemental disclosures, which are the what you call the notes to the accounts that now gives you more details about the financial statement that you've already seen. And so the primary goal of the financial report is to provide the financial information that is useful to different people you call users of the financial information. Um, so apart from the users that are already here, there are several kinds of users. We have investors. So who use this financial statement? Why is financial reports even important? Because everything we're looking at today circles around financial reports. Why is a financial report important? Um, because the financial report tells you what the company has done for a particular period, how what income have they made, what expenses, what is their profit. So the financial report tells you about their performance, and then it also tells you about their position at the end of a particular period. For example, if their financial year end is 31st December, what is the company's financial position as at the end of the year? What's the cash they have? What's the inventory they have? What's the where do they stand as at a particular date? Um, so the users of the financial reports are the investors, both existing and potential investors. For example, let's say you want to invest in Cadbury Nigeria, then you may want to look at their financial statements before you invest. So even though you've not invested, you're a potential investor and you need financial statements to before you invest. So you will be a user of the financial statement. If you're a lender, if for example a bank wants to lend to your company, you have a company, they would require that you have financial statements. Why do they need that? They want to look at the financial statement and say, oh, what's the capacity of this person to repay? Or what has this person done previously? Why should we give you a loan? So a bank, a lender, in that instance, will be a user of the financial statement. Then other creditors, some creditors actually give credit terms if they're waiting for you to pay back. Like if they're waiting for you to pay, they're supplying you goods, and then they're going to give you like 90 days term. They probably will need to see your financial statement to see how what position you're in for them to give you those term. If you're a bond holder, like recently I saw a bond, like one of the loan companies was selling commercial paper. So if you're going to invest in the commercial paper of a company, you want to see their financial statement. So the reason why I'm mentioning all those users of financial statements is when you read a financial statement, it's important to know that that financial statement is useful for different individuals, useful for different class of people, so that you know what do you want. And if you're a preparer of financial statements, you also know that that financial statement is going to be used by different categories of people. So as you're preparing it, you should just beware of that. Um, so we look at Accounting Standards Board. So financial report, if you looked at the financial report, one of the things you would see is that they come in different shape. They can be very small and they can be large. Now, one important thing is that if you leave it to companies to just decide what they want to put on financial statements, best believe that they will not capture everything. So that's why we have something called the Accounting Standards Board. So while we have Accounting Standard Board in almost every market, um, for example, in Nigeria, we had, I think it's NASB, Nigerian Accounting Standard Board, and those people who practice accounting, maybe if you studied accounting, I was not part of them, but if you studied accounting like 20 years ago, you probably will be reading SAS. Now, I've not heard of SAS in a long time because we look at IFRS. So, a lot of countries had their accounting standards board, national accounting standards board. But at some point, people thought like the world is a global village. We need to start coming together and have one accounting standard, like accounting standard board. So we have what we call the IASB, which is the International Accounting Standards Board, and they define financial statements should be prepared, how um, what are the general accepted accounting principles. So, for example, 15 years ago, we may not have been talking about anything like accounting for cryptocurrency, but now that's probably something that people will be thinking about. So, with time, with different geopolitical situations, um, accounting standards change. For example, after the 2008 financial crisis, a lot of these things had to be reviewed. How exactly do we recognize financial instruments? So crises will actually make accounting standards to change, um, different technology and the rest to make accounting standards to change. So um, we have IESB and they write the accounting standards and financial most countries a lot of countries adopt the ISB standards, which the standards they write is called IFRS. And the IFRS is used by many countries around the world, and some countries actually codify it. So you will see IFRS as adopted by XXX country because they've looked at IFRS, they've adopted they've now tweaked some things and say, based on our own particular situations, we want to change a part of how this IFRS is to suit our country. So I've spoken about IASB, FASB, which is the Financial Accounting Standards Board, is in the US and they write for they write the US GAAP. So the US have their own different financial standards, which is different for the rest of the world, as you can imagine. And so um, they have their ways of recognizing it. And so why is it important for you to know that there is a difference? Because if you want to buy a company that is, or invest in a company that is in the UK versus investing in a company that is in the US, you may just carry the both financial statements and say, UK company has 10 million of revenue, US company has 10 million of revenue. Say, let's imagine that the currency happens to be the same. But you may not consider the fact that revenue recognition or the costs that were recognized were done differently. So we'll look more about what the differences are between the IFRS and US GAAP. But what's important to note is that different companies may recognize differently. The standards that they use may affect how they recognize. And so it's not just about just like you cannot just compare the profit and say, oh, this company makes more profit than the other one. You may be simplifying it. So you have to consider what standards do they apply in preparing their financial statement and see if you need to make any adjustments based on that. Um, so we'll go now and talk about qualitative characteristics of financial reports. I remember when we started, I said everything that is in this course is about financial reports, financial statements, and we'll look at an example, a real life example of a financial report. But let's go on and explain. Now, qualitative characteristics of financial reports. So, qualitative characteristics are what make a financial report useful. Why is it possible that one financial report will be more important than another one? Um, so, a, finan- a financial report should have two qualitative characteristics. One is that the information is relevant if it should be relevant. It should information is relevant if it will potentially affect or make a difference in users' decision. So a financial report has to contain an information. If they exclude that information, then there is a possibility that the users of the financial statement, their decisions will change. And remember, I spoke about who the users of the financial information are: the lenders, the potential and existing investors, creditors, and the rest of that. Even government is also a user of financial statements because they may use financial statements to compute it to compute tax and to check what your liability to the government will be. So all information that can potentially affect the decisions of or the perspective of the users of the financial statement should be in the financial report. Then another characteristic is that faithful representation and um, information that faithfully represents an economic phenomenon that it purports to represent is ideally complete, neutral, and free from error. So as it should cover, financial statement should cover all the information that it needs to have. But in having those information there, those information should be correct. They should be complete, they should be neutral, and they should be free from error. And so that when you have those, you would have a um, a quality financial report. There are other characteristics that usually we would like to see in financial reports, such as like financial reports should be comparable, should be verifiable. So let me just explain some of them. Comparable means that if you prepare a financial statement in 2022, you should be able to compare it to 2021. And even that your financial statement should be comparable with the financial statements of other similar organizations. So they're not working in isolation and changing format. And so that's why we have the accounting standards. See that everything flows. That's why we have the accounting standards so that everybody follows the same set of standards and we can have something similar to a, a, a common set of financial statements that can be compared. Um, so another enhancing qualitative characteristic is that it should be verifiable. If you put 10 million as your revenue then somebody else, maybe the auditors, should be able to come and say, I can verify that this 10 million was actually your revenue. Then it should be timely. Like, imagine if somebody is bringing out 2020 financial statements and they are just releasing it in 2024. You know what happened in 2020? Like, what would you use 2020 financial statements to do in 2024? And so, um, that's why CAC, like the companies, and apologies if I'm using Nigerian specific examples. I think that's because I think most of the people here would be from Nigeria, and I will try to globalize it because most of these concepts are global. They may just be called different things in different climes. So I was saying the CSC, for example, mandates that certain kinds of organizations should publish their financial statements at a, or should submit their financial audited financial statements at a particular time. Different regulatory agencies also have that, like central bank, the stock exchange. If you're registered at the stock exchange, you need to submit it at a particular time, and that's because your financial statement, when it's late, it hinders decisions. Investors cannot make decisions if you're submitting it late. And then the financial statement should be understandable. It should have enough information that somebody with a reasonable knowledge of finance. So that's a downside. So if financial statement is prepared, assuming that if you have a reasonable um, knowledge of financial reports, then you should be able to understand it. They don't assume that anybody, even if like you've never heard anything finance, you can read it. They expect that you have reasonable um, reasonable knowledge of business and economic activities. So one of the issues now with preparing financial statements is you see how we say it should be quality, like it should be understandable, it should have all the information we need, but we also want it to have come timely. So this is one of the what we say constraints um of financial statements in that we want it to come timely, but we also want it to be quality. And so um it sometimes those qualities that you should have will clash. Like how exactly are we supposed to prepare financial statements? There's quality and it has to come timely. So sometimes it can be a constraint. Um, and there's some information that a, a financial statement may omit because it's not quantifiable. Like, just think about the brand value of companies. How do you value a brand? How much do you put on a brand? And yet, sometimes it is a company's greatest asset. How do you value the people that a company has? And sometimes it's their greatest asset, but it is not on the financial statement. So when you're reviewing financial statement, you also need to know that companies may have certain strong points that are not on the financial report. Um, so go to the next. So underlying assumptions of in financial statements. So when we prepare financial statements, we assume two key things. There are a lot of things we assume, but these are the key things that are always constant. One is accrual accounting. So accrual accounting assumes that financial statements should reflect transactions in the period when they actually occur, not necessarily when the cash movements occur. For example, a company reports revenues when they are earned. That's when the performance obligations have been satisfied, regardless of whether the company received cash before or after delivery. So I'll use an example. Some of us we pay subscription. You may pay subscription that covers the entire year. So what's the common subscription people pay yearly? Let's say you're paying a subscription for Zoom, for example. You want to use Zoom and then you pay a subscription. And so I'll give let's say you pay $1,200 and you're paying that 1,200 today, but and then you want to, let's imagine that today is December 1st, just to make it simple. You're paying 1,200 for the use of Zoom for December 1st, 2023, sorry, 2024 to December 1st, 2025. Now you've paid it to Zoom, the 1,200, but they cannot recognize the entire 1,002 this year. While they have received the cash, the income that they actually will be able to recognize in 2024 will be only for 1 month, because that 1,002, they have to spread it across the 12 months. So they will recognize $100 in December 2024, and then the remaining 1,100, they will recognize it between January and November 2025. So accrual accounting means, when would the transaction reflect? If a service will cover a particular period of time, then you split the revenue in the period. So you know this, in certain countries, people would pay for rent for 2 years. So if your landlord was a corporate and they received advance payments for 2 years, they would not recognize that rent in the year they received it. They will spread it across the year and then be recognizing it small as time is passing by. And that's because you have not earned that money. Yes, you've received it, but you have not earned it yet. You've not worked for it, more or less. And so I would link this to another concept we call matching concept in accounting, which is that the costs and the revenue the cost should be matched with the revenue in a particular period. So, for example, that rent situation, if a company is having rental income, chances are that in 2025, if they recognize all their income in this year, what about if 2025 they need to do some repairs in their house? So the revenue and the cost that pertain to a particular period should both be matched. So accrual accounting helps to ensure that the related revenues and expenses are recognized in the same period, which results in a more meaningful measure of net income. And then another assumption we use when we are preparing financial statements is going concern. So you assume that the company will continue to be in business for the foreseeable future. That is it. And so if there is any indication, anything to suggest that a company will not be in business for the foreseeable future, then there would be the financial statements will be prepared on another basis. But so any financial statement you see, you have to check that what is the basis? Are they assumed to be a going concern? And usually in the first few paragraphs in the notes, you already see whether there is a problem with the going concern. So the going concern principle is very important and is an underlying assumption in preparing financial statements. So let me just check if we have any questions before I go ahead to look at more accounting concepts. When you said goodwill, and I'm not even sure the context he said it, whether I was talking about when I was referring to brand name, brand value. Yes, I thought about it when I was saying that, but you can only recognize goodwill if the company is being sold. If the company is not being sold, you cannot just bring and say, we have a great brand value, so we're going to bring it on board. It's only when the company is being sold. So let me explain for the benefit of people who are here, and just because goodwill is an important concept that you will need to understand. So let's say you want to buy a company now. Um, you and the company's value, when you check their assets, there's their liability, their assets that you're purchasing, there's their liabilities. And let's say that amount is 10,000. Um, let's say the identifiable assets are 10,000 at the time you're purchasing it. Most times, even though what you see on the financial statement is 10,000, you will not pay 10,000 for that company because um, they have a lot of value that is not um, on the financial statement. So let's say you pay 15,000 to acquire that company. Meanwhile, their assets that you've taken over is 10,000. The remaining 5,000, you would record it as goodwill. So goodwill is what you pay above the purchase price, um, minus that's the amount you're paying minus the net identifiable assets. And so that's why you refer to goodwill. But most times you see goodwill will only be recognized when you are selling a company. You cannot just on your own start determining that, oh, we have goodwill, we have brand value, so let me bring it to a financial statement, except you're selling the company. So it says, do we only use the IFRS standard in Nigeria? To the best of my knowledge, yes, only IFRS standard. We don't use any other thing because SCS is dormant. Like I've never even heard of SCS in a while. I think at some point, maybe there are special industries that are still using SCS. I would be shocked if there are because I know one of the last set of companies I know to have transitioned to IFRS was pension funds. At some point they moved and they started using IFRS. So, to the best of my knowledge, is only IFRS that we use in um, Nigeria. Yeah. So, and even you can see any other person using that one, any other one. Is goodwill quantifiable? So I just explained how you calculate goodwill. If you buy a company and you pay 15,000 for the company and the assets that you actually took over and you will bring to your own balance sheet because you've taken them over is 10,000. So you take, let's say, 2,000 for inventory, 2,000 for cash, 2,000 for um, debtors, 2,000 for other assets, 2,000 for anything. You bring all of that. You merged it now with your own balance sheet. You that you're acquiring the company. That 5,000, you put it as goodwill. Every year you have to be testing impairment for goodwill. That can you still recover this amount? But I've actually seen companies, even though I think people say that goodwill cannot be depreciated or so. Some companies actually depreciate their goodwill, so they'll just say, "Oh, we'll amortize this goodwill for 5 years." So every year they'll just expense 1,000 the expenses. The next year they'll recognize it as expense. So companies actually expense their goodwill. As in for 5 years, 10 years, um, they expense their goodwill. So back to the accounting concept. So for those people who are not very familiar with accounting, and I wonder what are they talking about? Goodwill, receivables, rest assured, we'll cover them now. So these are when you hold a financial statement, the major financial statement, these five parts are what you see. And most of the things that we mentioned would be classified in one of these five. Now, the first one would be assets. So assets are what a company owns or controls. So we have examples like buildings, software. They can be tangible or intangible. So you can have buildings, you can have software, you can have inventory. You can have so inventory just be stock that you're waiting to sell, you're not yet sold them. You can have debtors. So debtors are um your account receivables, what people, your customers that are owing you. You can have cash. So anything that a company has or controls is an asset. In finance world, you define asset as an economic resource that is controlled by an entity and is as a result of past events and which we expect in the future will have economic value. So anytime we see assets on a company's financial statement, it means that in the future there is some sort of economic value that we expect to come from these assets. So liabilities are what the company owes, and just as like liabilities is almost like an opposite of assets. So liabilities, you expect that liabilities are obligations that a company has as a result of past events. The so an obligation is something that you have to do. You don't have a choice. You have to fulfill this obligation. Um, and so we expect that in the future there will be a flow of economic resources. So liabilities can be bank loan. For example, if you have a bank loan, you have an obligation to fulfill that bank loan. If you have creditors, that's people that you're owing because you have bought certain things, you have an obligation. If you have deferred income, I had used an example of if you pay for Zoom and you pay 1,200 and um, you pay 1,200 between December 1, 2024 to December 1, 2025. So I mentioned that because that Zoom that you've paid for covers a period of 1 year, then the company should only recognize 1/12 in 2024, which will be $100. The company will Zoom will recognize $100. Even though you've paid 1,200 in 2024, you only recognize $100 in 2024. The remaining 1,100, what happens to it? Does it go up in the air? No. It is recognized as a liability. It is called deferred income because they have an obligation. Zoom has an obligation to provide you with your services in 2025. They still have to ensure that they have staff, they have their assets, everything is running smoothly so that you can use Zoom in 2025. So that the remaining 1,100, they will recognize it as a liability in at the end of 2024. And then in 2025, every month they will, as you use the Zoom, use the app, they have used it to thank God, they would move $100 and recognize it as revenue from liability to now be recognized as a revenue. So that's asset and liabilities. I just want to check if I have any question on those. Okay, no question yet. Then equity they are the owner's residual interest in the company's assets after deducting its liabilities. So equity would be asset minus liabilities. And so if what you have minus what you are owing would belong to the owners. So unfortunately, sometimes you see that some companies are owing more than they have. Like, you see, personally, just think about it. If you have your, let's say you have bought a house, you have your car, you have your phone, you have everything. If you everything that you have, if you now have debt, you now subtract the debt from your assets, what the value of what you have, that will give you your as we say it, your net worth, to give you your net asset. But if you are owing more than you have, then you are in debt. You have a net liability. So equity is just asset, what you have minus liability. Now, revenue. Revenue is the amount charged for the delivery of goods or services in the ordinary activities of a business. But a more complicated definition would be something like revenue or income is an increase in assets or decrease in liability that results in increase in equity. So now let me explain it. We have discussed assets and we know that there can be land. Let's say you have a land in Maitama, Abuja, and that asset, as at 2023, is carried at fair value. So it was worth 10 million. But at the end of 2024, it has increased and you're valuing it now. And the land in Maitama is now worth 12 million. So it means that you've gained 2 million on the value of that land. And so you have a fair value gain is also an income, even though you've not received it. But the fact that the value of your asset increased, that's also an income. It's called a fair value gain. Also, if for some interesting reasons your liabilities reduce, um, for example, that can be maybe pension liability, a company owes, it reduced, then that also classifies as an income. Your what you are owing has reduced. Now, expenses. Expense is outflow, depletion of assets, liabilities incurred as a result of business activities. What we know as expenses, you spending money. You spend money as expense, but not every time. Sometimes the use of your assets can also be classified as expenses like depreciation, or if you're incurring liabilities, um, the it will also be recognized as expense. We'll talk more about depreciation and other kind of expenses later. Okay, so I hope we now understand the five critical accounting concepts, elements of financial statements. So I'll just go to the next one. But before I go there, let me check again. Just because I know that some people don't have deep finance background and so they will have some questions. Okay. So we have some finance terms that we just like to touch on, the ones I've not yet touched on. So accounting equation. Your assets should be equal to your liability plus your equity. So your asset is your asset is what you own. Your liability is what you owe, what you're owing, and then equity is what is left. So you see that the left side is the resources controlled by the company. That's what you own. Meanwhile, the right side is showing how those resources were financed. If you have any asset, for example, a company has any asset, is either they are borrowing money to buy those assets, or they're using the company's resources, that the shareholders' resources, to buy the assets. It has to come from the two. How else would you have assets? Assets don't come free of charge. So assets are resources controlled by the company, and then That's the left side, and then the other side is how the resources were financed. And so, if you know subject of the formula, which you may have learned in math class, if you want to get what equity is, what you have to do is assets, and then you move equity to the other, make equity the subject of the formula. So you just do assets. If you move equity to the other side, it becomes minus liability. So for you to get your equity is assets equals assets minus liabilities will be equals to your equity. And we already explained that equity is what is left, assets minus liability. So current versus non-current current assets are receivables use current assets or liabilities are receivable, usable, or payable within 1 year or one operating cycle of business. So if you have any receivable like inventory, short-term loan, they will be classified as current asset. If it is going to be used more than 1 year, it will be classified as non-current. We'll look at specific current assets and liabilities in a little while. So depreciation is the process of allocating or recognizing as an expense the cost of a long-lived asset over its useful life. Now, so I'll use an example as the depreciation. You buy a car in 2024. That car, you will not recognize everything as an expense in 2024, the cost of the car. So let's say you bought a car for 10 million naira. But if a company does that, you cannot just say, oh, it's an expense, and then you recognize it, because that car will be used over a period of time. So many companies depreciate cars or say over 4 years or 5 years. So I was just assuming this for 4 years. So if a company buys a car, that 10 million, they've gotten an asset of 10 million. What happens every year? That car needs to be depreciated. You have to recognize the fact that the car will be used over a period. So every year they are depreciating it by 25%. So they would every year they will take an expense of 2.5 million to expense it. So in the first year, after they've depreciated the car, so can somebody tell me what would be the value of the car left after the first year? So I'd say that a car is bought for 10 million and it is depreciated for 4 years. So they're recognizing expense over 4 years. So at the end of the first year, what will be the value of the car? Okay, thank you, Moyin. 7.5 million. So the depreciating for 4 years means you divide 10 million divided by 4 and you expense 2.5 million. So 10 million minus 2.5 million will give you 7.5. That's how much assets will be left after 1 year. So you just be recognizing 2.5 million of expenses every year. So cover that. Now we would look at income statement. What is an income statement? After this is when I'll be showing a real life example of income statement. So what is an income statement? You know, I spoke about financial statement, and I'm reiterating that the entire thing about this class, we're talking about financial statements. So one of the key income statements is one of the key financial statements called income statement. Sometimes you call it profit and loss account or statement of profit or loss. So this shows the financial results of a company's activities over a period. It shows how much revenue is generated and what cost is incurred in connection with generating that revenue. So it's just showing you how, I've been speaking about revenue. So for example, Zoom, and I spoke about that example of Zoom having 1,200 of revenue, of cash in December, and having to amortize it or recognize it over 1 year. So an income statement will show, okay, how many of that transaction has happened? What revenue did you generate? And what is the cost incurred to generate that revenue? Why do we have to prepare an income statement? Because it shows how profitable a company is. And what are the key concepts for income statement, which I've explained some of this. Unearned income, when cash is initially received and revenue may be recognized as being earned over time as products and services are delivered. Just an example would be that subscription for Zoom. And I already also explained that an example would also be a rental income for landlords. Now, when I say rental income for landlord, like think corporate landlord, not personal landlord. I don't need to prepare any personal financial statement. So when cash is initially an example of unearned income, or as I said before, it could be called deferred income, would be subscription payment service, payment received for a service that is to be delivered periodically over time. And then matching principles dictate that expenses should be recognized in the same period as the applicable revenue. So we'll go and show an income statement, and this one is for Apple. And I got it from 10K for Apple. It's a consolidated financial statement. It's a million, so this would be in 016, I think it's trillion. So you see that their net sales on the sales of product, that will be sales of iPhone and whatever other product they have, is 316, 297, 220. You can see that their revenue has been growing, and their services is a percentage of their services has also been growing as the product are growing. So something interesting, if you wanted to compute, we would be looking at what percentage of, just opening my calculator here, what percentage of their revenue, of their net sales is services. So I'll just compute that 78129 divided by 316,199. So about 24.7% of their revenue is coming from services, which will be like subscriptions and the rest. And let me compare that 24.7 in 2022, and if we compare it with 53, compared to 2020, what percentage that is. And then I'll explain why I'm doing this calculation. Sorry, let me do this again. So it's 8129 divided by 394. I used the wrong one. So that's 19.8. 19.8 for 2022 and 19.6. So in essence, their services and the ratio of their services is increasing in the same vein. In 2020, services was 19.6% of their total sales. Meanwhile, in 2022, services was 19.8, 19.6, 19.8. So it's still moving along same line. It can tell you that there has not been a massive change in how their revenue is being made. They're going the same way. Their revenue is increasing. You can see their cost of sales is also increasing. Research and development is increasing. Selling general and administrative expenses is also increasing. But you can see their operating income. They have operating income of 119. So that means show that they have something. Okay, so that will be, sorry, their operating income will be the gross margin minus operating expenses, and the operating income has almost doubled from 66 in 2020 to 119 in 2022. And then they have income taxes of 19,300 in 2022. So this is statement of consolidated statement of operations. It's also income statement, profit or loss. This is it for Apple. So I'll go to balance sheets. It can also be called statement of financial position. The company's like it shows what the entity owns, what they owe, and what the owners claim are at a particular point in time. It provides a snapshot of the business health at a particular date, and as mentioned, the asset is equal to liabilities plus equity. So if you want to get equity, to be assets minus liability, that'll give you equity. Okay, so I'll just speak to different kinds of assets now. So we have current assets. Current assets are expected to be received. Sorry, are expected to be received within 1 year or within one operating cycle. Financial assets are showed as amortized cost or fair value. So amortized cost is the historical cost minus any impairment. So if, for example, I had mentioned land would be recognized as fair value because you don't depreciate land. You cannot say, oh, I bought a land of 10 million in Waitama and then it's depreciated over 50 years. No, except it's building. The building on the land can be depreciated because it will be wearing out. But the land itself doesn't wear out with time. So a land, for example, will be classified as fair value. And if you buy bond, for example, you buy government bond, every year, if the government is paying, if it's a bond that is repayable over a period, every year you'll be receiving a particular amount and it will be the value of the bond will be reducing. And so the financial assets, sometimes financial assets can actually be classified as fair value because most bonds or a lot of bonds can be sold on the market. So you are, instead of looking at the amortization, what is the accounting value of the bond, you can decide how much can I sell this bond for if I'm selling it today, and then instead recognize those bonds as fair value. And so non-current assets, fixed assets are expected to last for more than 1 year. We have examples which is PPE, investment property, intangible assets. So intangible assets will be like software. If you buy a software, you can depreciate it over a period of time. Goodwill, I've mentioned that sometimes goodwill can actually be depreciated. Financial assets, some financial assets last for more than 1 year. So they will be recognized as non-current assets. And then deferred tax assets, what you expect to recover from the government in the future. So so we'll go to the next and talk about liabilities. So current liabilities are what you expect to be settled or what you expect to pay within 1 year or within one operating cycle. So operating cycle would be, see, different companies have different operating cycles. So for example, if you say you want to use an example of Cadbury and a construction company that builds house, Cadbury, when they buy their cocoa to when they actually sell the chocolate, it may be less than 1 year. It may not take them too much time. Or if, for example, you look at ShopRite, from when they buy from when they buy these things that they want to sell to when they actually sell it, it will actually be short. But now imagine a company that um that builds construct houses. Imagine how long it will take. Do you think they will have the same operating cycle as a Cadbury that buys and sells chocolate? No. So if you have a company that builds and construct house, from when they buy all the cement to when they actually sell the house, it may take them up to 2 years. So um, that's why you have to consider operating cycle. Their debtors, for example, may not be expected to be for a construction company. Their debtors may not be expected to be received within 1 year. It will be, if it is within an operating cycle, and I've just explained operating cycle, then it will still be um, classified as current liabilities. Non-current liabilities are financial liabilities that provide financing on a long-term basis, and that can include long-term loans, bonds, long-term lease. And then we have working capital. Working capital is what do you have to like run your business from day to day, and is the excess of the current assets over your current liability. Most times you expect that to be positive because if you have current liability, you need to settle it within like 1 year or one operating cycle, and you don't have enough current assets, that's cash, inventory, debtors, and the rest, to be able to pay off your current liability, and so that will be a crisis waiting to happen. So working capital is the excess of current assets over current liability. So we look at an example of a balance sheet. And we'll have for current assets, we have this for Apple, this is what they have. Cash and cash equivalent, marketable securities, which would maybe treasury bills or short-term secure commercial paper of companies, something like that. Accounts receivable, the customers that are owing them. Inventories, they keep small inventory. Vendor non-trade receivable. Okay, so the trade receivables would be accounts receivables next, which is here. Then other current assets with 21 to 23, which may include prepayments, and then the non-current assets that they have marketable securities. That may include investments in different companies, who knows? PPE, they have PPE, and then they have other non-current assets. So that is it for the assets, and then the liabilities that they have accounts payables, so their vendors that they will be owing money, the other current liabilities, deferred revenue. You know, I mentioned what deferred revenue is. So that's money that they received, but they still have an obligation to provide. So some people have all this different kind of Apple subscriptions, and so this is where your money that you've paid to Apple and you've not yet even used services for, this is where they'll see as deferred revenue. They have commercial paper, so um, they have say launch their own commercial. They have issued commercial papers, and so this is what is being owed to them. The term debt, the um, they also have debt, most likely a bank loan of 11 trillion. Then they also have long-term debts, most likely a bank loan of 98 trillion, and then other current, non-current liabilities, which include deferred tax liabilities and the rest of that. And so the equity, as we've spoken of several times, the equity will be the assets minus 352 minus the liabilities of 302. So that will be the equity of 50. So what do the shareholders have as at this date? It will be 5672. That's the receipt, that's the net assets that belong to the shareholders. So we'll go to statement of changes in equity. You know, we're talking about shareholders. So statement of changes in equity just shows information about the increases or decreases in a company's equity. What do they have? Now, there are three major parts of statement of changes in equity. One is we have issued capital, which is capital contributed by owners or common stock. Capital contributed by owners. It can also be called common stock or issued capital. So if you're going to start a company, for example, you would contribute some money to the company. Let's say you contribute 10 million. That is your equity. That's your issued capital. That is the amount that you have brought to start this business. Ownership of a corporation is evidenced through the issuance of these common shares. Preferred shares have rights that take precedence over the rights of common shareholders. The rights that generally pertain to receipt of dividend and receipt of assets if the company is liquidated. So sometimes the company needs more money, but they don't really want to share the upside. That's if there is a huge profit. So what they will do, they will issue preferred shares. There can be different reasons why they decide to issue preferred shares. But so a company issued preferred shares, and if you buy preferred shares, what happens is if the company liquidates, as it says, you are preferred, you collect your money first before the ordinary shareholders, and then you are entitled to a particular percentage of dividend every year. Ordinary shareholders, um, their ordinary shareholders may not collect dividends every year, but preferred shares, like depending on the kind of preferred share, they would usually collect their dividend every year. They collect it, but issued ordinary shares, they may not collect dividend every year. Retained earnings is the cumulative amount of profit or loss recognized in the company's income statement, which have not been paid to the owners of the company as dividend. So you know that we have spoken about. Let me just go to the other example. We have spoken about this. See, they have net income of 99 as at 2022. As at 2021, they have 94. As at 2020, 57. So if you've not given out any dividends and the only period that they have operated is just these three, then the retained earnings will be 57 plus 94 plus 99. That will be their total retained earnings. The retain as the word says retained earnings is the cumulative amount of net profits or net loss sometimes, because retained earnings can actually be negative. So it's the cumulative amount of net um, profits that Apple has earned during the period they have been in existence. So let's even see what their position is here. So you can see accumulated all their retained earnings is 3068, and given that they actually made um profits during the year, you can see that it changed from positive to negative, which is curious. So we'll see if we can see the reason why that happened. So they started the the year with 5562. They had net income, as we expect, of 99806. They declared dividend of 14793. Common stock withheld related to net share settlement of equity. So maybe they actually um, rewarded equity to, I guess, staff or something like that. That's minus 3458. But I want to explain and touch on this 9186, which is the major part. So when a company makes a lot of money, sometimes they decide to repurchase their shares. They would say, we have a lot of cash. What are we going to use this to do? So all the shareholders, you've done well, you've given us your money, thank you, but we now have a lot of cash. So we know we pay dividend, but also take your cash back. So it's like paying um paying back the shareholders the contribution that they had made previously, um, paying them, paying back the shareholders. So this common stock repurchase is them basically just paying back the shareholders for because they have cash. And you see that they've been doing that for the past 3 years, repurchasing their stock. So I'm just seeing Moyin's question. This can an operating cycle be more than a 12-month period? Yes, it can. I've given an example of a company that constructs houses, and a lot of companies that maybe see government as that government is their customer. Yes, operating cycle can be more than 12-month period. Um, a company that will construct houses, most times construction of a house will take more than 12 months. It will take up to 2 years, 3 years. If they're constructing a bridge, um, those kind of things will take time from when you first secure the contract to get your inventory delivered to when you sell and you close the transaction. It will take longer um, than maybe a shop, right, a retail store. And so that's why when you're comparing, you're not just comparing, oh, this company, their inventory is this size, this other company, their inventory is a small size. You have to consider what do they do, how does it apply. So yeah, my mm, so that just explained common stock repurchased, that's giving back the shares and reducing their see that if they're reducing their shares, then they would the value of the common stock would be reducing, as you can see in the first part of this. Sorry, Moin, what do you mean? What would they report? You said, but they will report on. Oh, yes, they will report. Their financial statements will still be reported on an annual basis. It only just affects what they classify as current assets slash current liabilities. Now going to cash flow. So cash flow statements show how a company's cash balance changed over the course of the reporting period. And cash flow has three components. One is operating activities. So operating activities show a company's day-to-day activities that create revenue, such as selling inventory and providing services. So, as part of cash flow, you would see, I'll just show you here. As part of cash flow, you see their operating activities. What exactly do they do? What are they in business for? You see it here. It is a part of operating activities. Now, I just want to give a distinction. Investing activities would be purchasing and selling long-term assets and other investments, e.g., PPE, intangible assets, and the rest. Now, there will be a distinction. If a company's business is to sell cars, the sale of those cars and the purchase of cars will not be recognized as investing activities. It will be recognized as operating activities because that is their day-to-day um that's their day-to-day operations. But if you're talking about a retail company like Cadbury, if they have some cars, like company cars, and they decide to sell it, it will be looked at as investing activities because that's not their primary activities. So the difference between where you classify it is what is the company in business to do, and that will determine whether it will be operating or investing activities. Now, basically, investing activities means purchasing and selling long-term assets and other investment. So, if you buy PPE, intangible assets, short-term investments in equity and debt, all those assets you buy, they will be included as investing activities. Interestingly, you can see that if Apple, for example, they purchase marketable securities, so it is in investing activities. They are selling, which I would say as maybe commercial papers, treasury bills, and the rest. When they buy it, it is included, or they sell it, is included as investing activities. But a bank, for example, they are if they are selling marketable securities or they are buying it, it will not be in investing activities because a bank must invest in marketable securities. They have to do all of this investment. So for a bank, investing in marketable securities would be their primary trade. So it would be included as part of operating activities. I hope you understand. It depends on what the business is, what the company is in business to do, why are they trading. And then you see financing activities. Financing activities include obtaining or repaying capital, such as equity and long-term debt. The two primary sources of capital are shareholders and creditors. So we have looked at this asset um, asset equals to liability plus equity. And so financing activities just shows what are the transactions between the financiers, those people who are funding your business. I know we had seen previously that Apple had commercial papers. So commercial papers would be people subscribing and giving Apple some sort of loan, short-term loan. So that will be in financing activities. All their transaction with their shareholders, where we had looked at, they had dividends, they repurchased stock, they had proceeds from issuance of term debt, which is most likely a bank loan. So all of those financing activities between with their shareholders or their long-term liability partners would be their or that has to do with liabilities would be included as financing activities. Now, it's important to know that there are two methods of preparing cash flow. There's the indirect method and there is the direct method. Most companies use the indirect method, and this is the indirect method. The um, the direct method, instead of showing where we have here, and you see operating activities, net income, and then you add back depreciation and amortization and all of this, you're adding them back. For direct method, they will just show it straight. Cash generated from sales of goods, cash paid for services, and everything will be shown line by line instead of just putting everything as net income. So just wanted to mention that this is an indirect method of preparing cash flow statement, which will be different from direct method. Yeah, cover the next question. Now, bringing it all together, income statement would be income minus expenses. We show profit or loss for the year, and then that profit or loss goes to equity. And I'd explain how sometimes deferred revenue, for example, subscription, part of it will be recognized as liabilities, the other part of it will be recognized as income. So you see that all the transactions flow together, and then cash flow for the year is generated um, from you cash flow for the year. You can see how it's linked to balance sheet. As I was explaining the cash flow of Apple, I was also going to the balance sheet to show you, oh, this is where it is. This is the cash flow of Apple, and you can see purchases of marketable securities. Part of it would have been recognized in this balance sheet, which is marketable securities, which will be here 120805. So it's all linked together. The income statement shows you the result for the year. The balance sheet shows you the position as at the end of a period. And then the cash flow statement is between the periods. So you see, while income statement does accrual accounting, where you accrue for income based on the when you generate it, when you generate the income. Cash flow statement is about when did you receive the cash, how much cash did you get, and I just wanted to touch on why cash flow is important, because cash flow shows what do you have and how do you use it. Now look at this. Okay, so even though the net income was 99,803, their cash generated by other or by operating activities is 122. It's quite high. And so everything we're now looking, this money that you generated from your operating activities, from what you are in business to do, this money that you generated, what did you use it to do? Let's see, how did they use the money that they generated? The major thing they used that money to do was to pay back the shareholders, as you can see in these financing activities, was to pay back the shareholders through repurchase of common stock of 89,402. Another key thing they used the money that they generated to do is to buy marketable securities. So instead of just leaving cash down, they bought some marketable securities, which would be maybe commercial papers, treasury bills, and the rest of that. And so a statement of cash flow shows you where they got their cash from and how they have used that cash during the period. So that would be it about the introduction. So I'll just explain the difference between profits and cash flow. We have looked at cash flow and we have looked at profits. Now, the difference between both of them is time. When did you recognize it? The sales profits would just be sales minus expenses, while um, the cash flow will show that cash inflows minus cash outflow. So I mentioned that example of paying for a Zoom subscription. Now, if you pay for the Zoom subscription in 2024, part of it will be, if it's for 1 year, part of it will be recognized in next year. Even the company that is paying for the Zoom subscription, they've not enjoyed the service, so they will only recognize part of it in 2024, and part of it will be recognized as an expense in 2025. Now, the difference is just time, because you have the money, but it's about when you actually recognize it. So, difference between profit and cash flow is just the time when you get it versus when you accrue or you recognize it. Okay. Um. So I want to. So I just want to give a little example. So a customer pays $100 for 1 year iCloud Plus subscription on July 1st. Assuming Apple's financial year end is 31 December, how much will they recognize as cash inflow and revenue for the year? So can we do just the simple? I know some of us know it, but can you just answer this? How much will they recognize as cash flow and revenue in the year? Yes, so I want to just waiting for the responses to come in. All right, thank you everyone. Um, so Apple will recognize their cash. A customer has paid $100 for 1 year, so the cash inflow so for Apple will be $100 because that's how much they actually recognize as cash. The revenue would be because they paid from July 1st and Apple's financial year end, as hypothetical, is 31 December. That's half year. So the amount that will be recognized as revenue will be 100 divided by 2. So they only recognize revenue of $50 in the year. Now the second one is Apple pays for Microsoft Navision software $1,000 and is expected to be used for 5 years. How much would be recognized as cash outflow and expenses in the year? So thank you everyone who is responding. Um, Moye Afo, Ohanaka, Clement, Izini, Bisola, Ejo. Thank you very much for responding. So if they paid for 1,000, they paid for Microsoft Navision software 1,000. The cash outflow would actually be 1,000. It's expected to be used for 5 years. So the amount they recognize as an expense, the actual use of the software would be 1,000 divided by 5. So they'll be recognizing as an expense only $200 in the first year, and then every year they'll be recognizing $200 until the 5 years is passed. And so just as also in at the end of the first year, what will happen is they've received $100, so that would have come in as cash. That would have they paid $1,000. That would have gone out as cash. 200 of it will be recognized as expense, and the remaining 800 will be recognized as prepayments. So every year they would remove it from prepayments and recognize it as expense. And prepayment is classified as an asset. So it's like a resource that you control. You have the right to receive some value from Microsoft Navision in the subsequent years. So you would put that 800 as prepayment. So another knowledge check, which of these is an asset? Inventory, borrowings, accounts payables, which of this is an asset? Inventory. Okay, just reminding you that an asset is a resource that is controlled. So if you have inventory, is what you have to is a resource that you control. Then which of these should be classified as investing activity in the cash flow statement? Thank you. So payment of salaries will be the core operations of a business. So payment of salaries will be classified as operating activity. Purchase of property, plant and equipment is an investing activity. It is what you're buying, and so it should be classified as investing activity. Then interest payments. I'd explained that financing activities is transactions between a company and their shareholders or their financials. So their interest payments will be classified as financing activity. So we're going to look at components and format of the income statement. We just looked so what we've done is like an introduction. We're going to go more in depth now on income statements. Okay. So we'll start with, when we started, we looked at accounting standards, and we're just going to build on the introduction that we have. So let me just stop for a minute and see if there is anything that we've done before I build on it, to see if there are any questions that we can take now before we continue. If there is anything I've touched on and you have a question, and please can you Okay, so another thing I want to know is, do you think it would be beneficial to just have a little section at the end of the class to discuss about challenges in studying for CFA and the others? If you think it would be beneficial, just write yes. If you think we should just focus on FSA, then just ignore. But if you think it would be beneficial, write yes, and we would discuss about preparing and optimizing the chances of passing CFA. Okay. If I see enough responses, then we will. But if we don't, then it means people don't think it's important. Okay. Okay. So at the let me count how many years I have. 2, 3, 4, 5. I think I have almost. Okay. Thank you. So at the end of the class, we just use a few minutes, and then you can ask any question. I can tell you about how to optimize your chances um, to pass CFA. So we'll just discuss for the next 15 minutes or so before we go on a break. So let's continue. Okay, so we'll look at convergence of standards. So I've spoken about IFRS and US GAAP and basically talking about IASB and FASB. IASB being International Accounting Standard Board, the right accounting standard, the right IFRS, and then FASB is Financial Accounting Standards Board, and the right US GAAP. So at some point, these two major bodies looked at it and thought revenue recognition is very important, and you see is what we call top line. Revenue is the top line, and they decided to um, introduce nearly identical standards for revenue recognition. The IFRS for their own IFRS 15, and then FASB called theirs ASC topic 606. This was issued in 2014, and the aim was to harmonize revenue recognition globally so that it can be comparable. Because imagine if one company in the US, they're using US GAAP and they're recognizing differently from another company in the UK, it doesn't make it comparable. So the aim was to harmonize revenue recognition. And what's the core principle? The core principle is what we've been talking about since, that revenue should reflect the transfer of goods or services to customers for the expected consideration. It should reflect the transfer of goods or services to customers. And so you see all those explanations we have been given about um, um, Zoom, if you buy subscription, as the services are being offered, that's how the revenue should be recognized. But sometimes it can be more complicated than that. There are 5 steps for recognition before you recognize the revenue. There are 5 steps. One is identify contracts with a customer. What contract um, do, do you have with the customer? And what are the performance obligation? What are you supposed to do? Now, if, for example, we look at a construction company, let's say ABC Construction Company has been hired to construct a house. Like I want to have a luxury house, and then I contract a company, construction company to construct that house. How, let's say the cost of the house is going to be 100 million naira, and they've estimated it to take 3 years to construct my luxury house. Would it be fair for them to recognize revenue and say it will take 3 years, so we just recognize 33 million every year as revenue? Would it be fair? I don't think so. Because it is not like Zoom subscription where the services will be identical from period to period. This year, they may spend a lot on buying cement and laying the groundwork and whatever they do in construction. Next year, it may be roofing and the rest of that. And it may not, the cost cannot be simply spread across the 3 years and just do 100 divided by 3. So let's recognize that 3 million for each year. No. So you have to determine what the distinct performance obligation and a contract normally you would have those, what are the milestones? Is it for them to, I really don't know a lot of those technical terms, but is it foundation they want to do? Is it building of their house? Is it roofing? Is it the when they're even done with that? How about um the finishing of the house, the furnishing, whatever they need to do? Um, so they have to identify what are the distinct performance obligation. What is the transaction price? I had mentioned the transaction price is 100 million. And then you now have to allocate the transaction price to the obligation. So let's now say the obligation, you've decided that, oh, the foundation part of it would cost about, would take about 10% of the resources. So let's recognize 10%. Once we are done with the foundation, we'll recognize 10% of the contract value. So you allocate the transaction price to the obligations and you recognize revenue upon satisfying those obligations. What I've seen in practice, a little of this is that people can actually recognize based on cost. So let's say that, you know, the, the construction company is going to receive 100 million, but it doesn't mean that 100 million is going to be their cost. So let's say what they actually see as their cost, or to make it simple, what the cost of constructing my luxury house to the construction company is going to be 50 million. So some of what they can do is that if they've spent 10 million, they've already spent a cost of 10 million, you look at it that, so our expected cost is 50 million, but we've already spent 10 million. So that's 20%. Okay. So that means we can recognize 20% of our expected revenue, which is 20 million. So you recognize revenue of 20 million, cost of 10 million. So as they're incurring costs, they will be in the same proportion, you'll be recognizing revenue. So that can be how they would recognize it. So you have to know what are the performance obligations, determine the transaction price, and allocate the transaction price to the obligation. Then recognize revenue upon satisfying the obligations. Distinct characteristic is that under IFRS, income includes both revenue and gains, with gains typically arising from peripheral activities. You know, I had mentioned previously that um, gains can also include increase in the value of land, as I said that if you buy land in Mitama, then your land will probably be increasing. So that's also some sort of income. So the next one we're going to look at now. The entity will recognize revenue when it is able to satisfy the performance obligation by transferring control to the customer. Following are factors to consider when assessing whether the customer has obtained control of an asset at a point in time. So I'm using different kind of examples and illustration for you because some of you may be in different industries or have to analyze companies in different industries. So as we're looking at tech companies, how you recognize one, looking at construction companies. Now let's look at retail companies, companies that actually sell products. So apart from also of allocating based on work done and the rest, as I'd explained for a construction company, when you want to consider when recognizing revenue, you want to consider 5 things. Does the entity have a right to payment? Does the customer have legal title? Have they had possession physical possession, do they have the significant risk and rewards of ownership? And as the customer accepted assets, all this may look vague, but let me explain. If a company in China is, or let me even use Nigeria, you're in Nigeria and then you are selling, let's say, you're selling crude oil to a company in the US. At what point do you recognize the sale of the crude oil? Is it once they accept? So you have to, now it's not the day that you have the crude oil that it will get to the customer. So you have to consider, have you actually given them the invoice? Do you have a right to the payment? Most times it will probably be recognized once it is out of the hands of the seller and all the significant risk and reward has left my shop and it is headed to you, and now it is your responsibility. Does the customer have physical possession? Do they have legal title? Has the customer accepted the assets? And so those are things that you consider. Consider this a company that is selling cars. They've sold a car, but the car is still in their lot. Imagine if there is some sort of let's say fire outbreak. Who bears the risk of if that car is stolen in the lot, that car that has been sold, who bears the risk? So those are some of the things you consider in determining when to recognize revenue. All this may look abstract and you may be wondering why exactly are we bothering about this? But if it is the end of the year and people just want to recognize revenue at the end of the year, then somebody may have just said, oh, I have pushed it, I've sent it to them. Meanwhile, the risk is still with you. So that's why that cutoff is important for you to determine exactly when they sell. And another thing is comparing between two companies. One company may say that once we have sold it, even if it is still in our lot, it is we recognize it as revenue. Another company will say it is when it is delivered to the customer that is when we recognize revenue. And so you have to look at those two companies. They may have a slightly different revenue, even if they have the same kind of transaction, because um, they're using different methods of determining when to recognize revenue, whether it is at the point of sale or at the point of delivery. So that's why you have to take into consideration these differences um, in revenue recognition standards. So we look at revenue and then we look at expense recognition now. Um, so for IFRS defines expenses as decreases in assets or increases in liabilities that will lead to equity decreases, while FASB calls it outflow or uses of assets or liabilities from delivering goods, services, or other central operations. Um, so even though like the explanation is different, it's almost the same thing in application. And we'll look at two important kinds of expenses. One is doubtful accounts. So companies have to estimate uncollectible revenue at the time of sale based on prior experience. You know that sometimes companies will sell on credit, um, but now they have to estimate how much of this revenue, how much of these sales we've made are we not going to collect? And they have to do that based on prior experience. It may be a percentage of overall sales, or total receivables or overdue amount. So I'll just give an example. If a company is selling to distributors, so to just selling to distributors, and they have sold, let's say, 15 million worth of goods to their distributors. At the end of the year, if they've not yet gotten the entire 15 million, let's say 1.5 million is still outstanding, they have to determine how much of that 1.5 million are you expecting to recover. And it may be as a percentage of sales or as a percentage of that 15, that 1.5 million that we are still expecting, or it may be a percentage of the overdue amount. You can look at it that all the overdue amount, once it is overdue, we only collect 50% of the doubtful account. So depending on the company, they may estimate how much they expect to cover, and those expenses would be recognized as those uncollectible or doubtful amounts, provision for bad debts, as we call it, will be recognized as an expense on the income statement. You will not go and reduce the revenue and say, "Oh, I sold it, but I'm not going to. It looks like it's not going to come again, and now reduce the revenue." No, you would include it as an expense, provision for bad debt. That's as it seems now. We estimate that maybe 150,000 out of what we have as receivable will not be collected, and then you recognize it as an expense. And then warranties. Many companies stand behind their products by offering warranties, and when a product falls short, the company bears the cost of the repair or replacement. For example, look at your phones. You have warranties. Some of them will come with 1 year warranties. Them just use phones, for example. We cannot wait until these costs are incurred to recognize the expense in line with the matching principle. So you have to estimate the future expenses related to warranties at the time of the sale. So imagine like some products actually have 10 years warranties, like freezers and the rest of those. So when there are warranties, a company will have to estimate. They may say, let's say 3% of the sales that we have eventually go as warranty cost, maybe cost of repairing or cost of replacing the um, the product. So instead of recognizing it only when the warranty claim comes, they would recognize an estimate of the warranty costs in the same period as the sale, so that these expenses will match up to the revenue that they are associated with. So during the life of the warranty, if it is 10 years, as the claim is coming, they will be adjusting it. They'll be adjusting the level of warranty based on the actual experience that they're having. For example, they may be having more quality products that warranties are no longer coming, because those products warranty claims are no longer coming. So even if you're still having that, you're giving customers 10-year period to come and claim their warranties, but your products are getting more quality and they are not claiming. You may now have to, let's say, instead of making it 3% um, warranty provision, you may now decrease it to 2%, because actually you are seeing a decrease in claims over time. So those expenses have to be recognized in the period to which they relate. So now we'll look at, I promised that we'll go on break, but let's just finish this part, this income statement part before we go on break. Okay. We have 3 more slides. 4. So we'll look at um, depreciation and amortization, expense recognition for um, expense recognition for long-lived assets. Cost of long-lived assets are allocated over the period they provide economic benefits. Land and intangible assets with indefinite life are not depreciated or amortized. And so I'm giving an example of a car of 10 million and it could be depreciated. So that example we had used where we say we have a car of 10 million and we are depreciating for 4 years. So it means we only recognize expense of 2.5 million every year. But let me give an example of where you use units of production. Let's say you have a printer, a commercial printer, and that printer is expected to only be able to print 10,000 books over the life of the commercial printer. So if you bought that printer for, just to make it simple, you bought the printer for 20,000 USD, and the estimated units of production you get from that printer is 10,000 units. You can say, okay, in this year we were only able to print um, 5,000 books. So we've used up half of what we expect this printer to be capable of. So we're going to depreciate this printer by half. So in units of production, you're trying to depreciate it as you're using the product based on what you expect, how the capacity of the machine. You're depreciating the machine in line with the expected units of production. So you can see this when you have all these machines that they have expected number of units that they are expected to produce. Amortization is similar to depreciation, which is a systematic allocation over the useful life of an asset, but it applies to intangible assets like patents, or copyright, or softwares. For example, some drugs may have patents of 25 years. So if a drug has a 25-year patent, whatever the cost is, to be allocated over 25 years. The cost of the patent will be allocated over 25 years, and then it will just be amortized because you expect to get value from that drug that you have, the research and everything. You expect to get value from the patent for 25 years. So you would just recognize the expenses just as you expect to get value from the patent. Then valuation model. IFRS allows us to use cost model and revaluation model. So you can value an asset at fair value, but US GAAP only allows us to use cost model with annual review of the residual value and useful life. So residual value is how much you expect the assets to sell for. So at the end of the useful life of the asset, how much do you expect to this asset to sell for? So the implication is that the choice of method can affect the reported net income, with accelerated methods being more conservative early on. If it is an accelerated method, you mean it can be used for something like a car. You buy a new car, in the first year it depreciates steeply than in the subsequent year. So if you have a car, for example, you would have they can decide to use accelerated method. If a company is using accelerated method and they're saying, okay, we're using 40% of the car, we're depreciating it in the first year, and then in the second year, we're depreciating it by 20% and the rest of that. Their expenses and their net income will be different just because another company is using straight line method um, instead of diminishing balance method. So I just saw a question now. When asks, would this warranty be covered by provision on the income statement? And how would we adjust the change in provision in the following year if the preceding year was under or over the projection? So, so for the warranties, if, for example, this year we had 10 million worth of sales, and we think we need to make a provision of warranty expenses of 3%. So we make provision of 3%, we expense it. So what we do is debit expense of 10 million times 3%. I think that's 300,000. We would recognize expense of 300,000 and have a warranty provision of 300,000 in the financial statement as it's being used. If it is being used and some claim is coming, then we'll be reducing the warranty. But if next year we now see that, oh, we actually do not have claim, and we now have quality product, and we can safely reduce our warranty to 2.5%, then you may have to reduce the warranty that you have on the financial statement. You reduce the warranty, and if you're reducing a liability, as we had said, if you're reducing a liability, it comes back as a gain in the financial statement. Means that this is leading to a lot of games. That's why financial accounting and reporting is interesting. There are a lot more games, trust me, a lot more games. I think this is the last before a question, and then we'll go on a break. So we have common size analysis. So the purpose of common size analysis is to assess financial performance over time or against competitors. So like one company is making 10 million, another one is making 2 million. How exactly do you know you want to invest in? Or would you just go and say, oh, this one is making 10 million. Yeah, this is the one I would go for. It may not actually be the best for you to invest in. And so common size analysis is putting everything as a percentage so that you can compare. It facilitates time series and cross-sectional analysis. So time series will be comparing it from year to year, comparing Company A's financial statement as at 2022 with Company A financial statement as for 2023. And then it also helps you to be able to cross-sectional analysis will be comparing different companies together. And so you can do this by standardizing data. You can see for Company A, for example, you put sales as 100%, and by the time you look at the operating profit, it's 20%. Look at Company C, you're making 2 million of sales, and the operating profit is still 20%. So you may do just as good investing in Company C as you would in Company A. But if you are choosing Company B, if you had a choice between Company B and Company C, and you chose Company B because it had more sales, you may be making a wrong decision because Company C's operating profit is a higher percentage of revenue. So that means they are more efficient in they get more for each revenue that they have than company B. There are a lot of other ratios, and you cannot make a decision based on only this common size analysis. But this one would help you to be able to compare companies together. So we'll just look at one question before we go. So which of these statements is most accurate? A common size income statement restates each line item of the income statement as a percentage of net income. B, a common size income statement allows an analyst to conduct cross-sectional analysis by removing the effect of the common size, and C, standardizes each line item of the income statement but fails to help an analyst identify differences in companies' strategies. Read it again. So it says restate each line item of the income statement as a percentage of net income. So if you look at this, it was a trick question, and that's how CFA questions that they can be tricky. So it's as a percentage of sales. Everything is like you can say operating profit is 2 million over 10 million. So common size we state each. Thank you very much for your comments. Thank you. So common size income statement we state each line item of the income statement as a percentage of revenue. So it allows an analyst to conduct cross-sectional analysis by removing the effect of company size, as we saw, and then it actually standardizes each line item, and it can help you to identify differences in company strategies because when you look at it, you may be able to say, oh, this company is actually like their cost of sales is see company A and company B. Company B's cost of sales is 75%. Meanwhile, company A's cost of sales is 30%. So there's a different strategy. If all these companies are in the same industry, it means that there is something that company B is doing different from company A. And if you have more idea about this companies, you may be able to tell, okay, it's because of this. That is why they have company B has higher cost of sale percentage than company A. So let's say we have 15 minutes break. I hope that's
Sorry,
okay.
sorry,
Yeah.
does it mean that C is the answer?
Yeah, go ahead.
Does it mean that C is the answer?
No, B is the answer. C actually says, but fails to help an analyst. So it doesn't fail to help an analyst. It actually helps to identify differences in company strategies. So B is the answer. Sorry, I was not very clear with that. So B is the answer. Yes, so we'll just have 15 minutes break and then we would be back to finish up. And remember, at the end of the class, we'll just take a few minutes to just talk about what questions that you have concerning study for CFA. And if you have any questions, please start writing them down so that you don't forget and so we can have a productive time. So enjoy your break. Thank you. Yes, Moe, depreciation and amortization expenses and operating expense, but it depends. So it depends. Depreciation and amortization expense may be classified as cost of sale if it is a machine that is used to if it is a machine that is used to produce, that is directly used in production, the depreciation, like the one I had mentioned, where they have a printer that they're using to print book. If you're a publishing company, that printer, the depreciation of the printer may be recognized as cost of sale. There's a lot of games. Oh yeah, there's a lot of, it depends. There are a lot of things that are not absolute in accounting. It depends. All right then. See you in 15 minutes.
New Frontiers Learning is the #1 tuition center for the CFA exams in Nigeria. Our founders went through their CFA journey with little or no support of any kind. However, they vowed to turn into reality the dream of every CFA candidate earning the CFA charter, irrespective of their backgrounds, finance and non-finance alike. It is this commitment to support our candidates that influences our engagement of a world-class faculty, partnerships, scholarship and discount offers, our online learning management system, and so much more. Our clients' outstanding results across all levels of the exams every year attest to the quality of our top-notch physical and online program in the last 10 years. That's right, we have been impacting the industry for 10 years and have supported about 2,500 professionals in that time space. Register with New Frontiers Learning today. New Frontiers Learning is the #1 tuition center for the CFA exams in Nigeria. Our founders went through their CFA journey with little or no support of any kind. However, they vowed to turn into reality the dream of every CFA candidate earning the CFA charter, irrespective of their backgrounds, finance and non-finance alike. It is this commitment to support our candidates that influences our engagement of a world-class faculty, partnerships, scholarship and discount offers, our online learning management system, and so much more. Our clients' outstanding results across all levels of the exams every year attest to the quality of our top-notch physical and online program in the last 10 years. That's right, we have been impacting the industry for 10 years and have supported about 2,500 professionals in that time space. Register with New Frontiers Learning today. New Frontiers Learning is the #1 tuition center for the CFA exams in Nigeria. Our founders went through their CFA journey with little or no support of any kind. However, they vowed to turn into reality the dream of every CFA candidate earning the CFA charter, irrespective of their backgrounds, finance and non-finance alike. It is this commitment to support our candidates that influences our engagement of a world-class faculty, partnerships, scholarship and discount offers, our online learning management system, and so much more. Our clients' outstanding results across all levels of the exams every year attest to the quality of our top-notch physical and online program in the last 10 years. That's right, we have been impacting the industry for 10 years and have supported about 2,500 professionals in that time space. Register with New Frontiers Learning today. New Frontiers Learning is the #1 tuition center for the CFA exams in Nigeria. Our founders went through their CFA journey with little or no support of any kind. However, they vowed to turn into reality the dream of every CFA candidate earning the CFA charter, irrespective of their backgrounds, finance and non-finance alike. It is this commitment to support our candidates that influences our engagement of a world-class faculty, partnerships, scholarship and discount discount offers, our online learning management system, and so much more. Our clients' outstanding results across all levels of the exams every year attest to the quality of our top-notch physical and online program in the last 10 years. That's right, we have been impacting the industry for 10 years and have supported about 2,500 professionals in that time space. Register with New Frontiers Learning today. New Frontiers Learning is the #1 tuition center for the CFA exams in Nigeria. Our founders went through their CFA journey with little or no support of any kind. However, they vowed to turn into reality the dream of every CFA candidate earning the CFA charter, irrespective of their backgrounds, finance and non-finance alike. It is this commitment to support our candidates that influences our engagement of a world-class faculty, partnerships, scholarship and discount offers, our online learning management system, and so much more. Our clients' outstanding results across all levels of the exams every year attest to the quality of our top-notch physical and online program in the last 10 years. That's right, we have been impacting the industry for 10 years and have supported about 2,500 professionals in that time space. Register with New Frontiers Learning today. New Frontiers Learning is the #1 tuition center for the CFA exams in Nigeria. Our founders went through their CFA journey with little or no support of any kind. However, they vowed to turn into reality the dream of every CFA candidate earning the CFA charter, irrespective of their backgrounds, finance and non-finance alike. It is this commitment to support our candidates that influences our engagement of a world-class faculty, partnerships, scholarship and discount offers, our online learning management system, and so much more. Our clients' outstanding results across all levels of the exams every year attest to the quality of our top-notch physical and online program in the last 10 years. That's right, we have been impacting the industry for 10 years and have supported about 2,500 professionals in that time space. Register with New Frontiers Learning today. New Frontiers Learning is the #1 tuition center for the CFA exams in Nigeria. Our founders went through their CFA journey with little or no support of any kind. However, they vowed to turn into reality the dream of every CFA candidate earning the CFA charter, irrespective of their backgrounds, finance and non-finance alike. It is this commitment to support our candidates that influences our engagement of a world-class faculty, partnerships, scholarship and discount offers, our online learning management system, and so much more. Our clients' outstanding results across all levels of the exams every year attest to the quality of our top-notch physical and online program in the last 10 years. That's right, we have been impacting the industry for 10 years and have supported about 2,500 New Frontiers Learning. Our founders went through their CFA journey with little or no support of any kind. However, they vowed to turn into reality the dream of every CFA candidate earning the CFA charter, irrespective of their backgrounds, finance and non-finance alike. It is this commitment to support our candidates that influences physical and online program in the last 10 years. That's right, we have been impacting the industry for 10 years and have supported about 2,500 professionals in that time space. Register with New Frontiers Learning today. New Frontiers Learning is the #1 tuition center for the CFA exams in Nigeria. Our founders went through their CFA journey with little or no support of any kind. However, they vowed to turn into reality the dream of every CFA candidate earning the CFA charter, irrespective of their backgrounds, finance and non-finance alike. It is this commitment to support our candidates that influences our engagement of a world-class faculty, partnerships, scholarship and discount offers, our online learning management system, and so much more. Our clients' outstanding results across all levels of the exams every year attest to the quality of our top-notch physical and online program in the last 10 years. That's right, we have been impacting the industry for 10 years and have supported about 2,500 professionals in that time space. Register with New Frontiers Learning today. Through their CFA journey with little or no support of any kind. However, they vowed to turn into reality the dream of every CFA candidate earning the CFA charter, irrespective of their backgrounds, finance and non-finance alike. It is this commitment to support our candidates that influences our engagement of a world-class faculty, partnerships, scholarship and discount offers, our online learning management system, and so much more. Our clients' outstanding results across all levels of the exams every year attest to the quality of our top-notch physical and online program in the last 10 years. That's right, we have been impacting the industry for 10 years and have supported about 2,500 professionals in that time space. Register with New Frontiers Learning today. Frontiers Learning
Okay, I think are we back? Are we back? If you're back, just say hi in the chat box.
Hi.
Let me know. Okay, thank you. Yes, so we'll be continuing with balance sheet now. So, we had looked at it previously, but we'll be looking at it in more detail now. Um, so balance sheet has several components, and that includes some referencing some of the things that we have seen previously in the sample financial statements. It has cash, receivables, inventory, marketable securities. So cash will be from cash or cash equivalent, what you have, short-term, highly liquid investment. So even when we have something like your treasury, your fixed deposits, it can be included as cash because it's highly liquid. That's if it's for a short time, like usually less than 90 days, it can be included as cash. So marketable securities are financial assets, and this includes debt or equity securities that are publicly traded and whose values can be determined from public information in a public market. As it says here, marketable securities. So they should be marketable. It should be something that you can sell. Um, it is on the stock exchanges, on the exchange, so it can be sold and can be bought. That would be marketable securities. So if you have something like time deposits or loans to staff loans or other receivables, that will not fall under this. So we also have um, trade receivables. Trade receivables are amount owed by customers, and it should be reported at net realizable value. So it's not just because they are owing you that you put it as debtors. If you do not expect to recover everything, then you cannot put everything as debtors. How much exactly are you expecting to recover from them? If, for example, you have debtors trade receivable of 70,000, and one of your customer that is owing you 20,000 has already gone bankrupt, and they cannot refund, you cannot get your total 20,000 from that customer. So let's say you cannot even get anything from that customer. It means that you have to reduce your assets by 20,000. The amount that you have as trade receivable will be only 50,000. So it should be only amount owed by customer, and should be only what you expect to recover, not realizable value. And so we also have inventory. So inventories are measured at lower of cost and net realizable value. So now this may look confusing until you consider some industries. Imagine a company selling phones, for example. Let's say, this phone retailers, they bought iPhone 13. If they had bought it for, say, $1,000, iPhone 13 will not be the same amount today. So sometimes the value of the phones may actually be decreasing to less than the amount they had bought it to. So if they bought it for $1,000 and they still have it in their inventory, but nobody will buy it for, imagine that nobody will buy it for $1,000 and the amount that they can get for the iPhone 13 today is $800. Then they will have to recognize the difference of 200 as an expense. They have to reduce the value of their inventory. Inventory has to be carried at the lower of cost and net realizable value. How much can you realize if you sell this inventory? So we have other current assets, which would include prepaid expenses and other non-material items. We'll touch on some of this in more detail. So we also have current liabilities. So current liabilities are obligations that are due within 12 months or within the operating cycle. And I explained that operating cycle can be lower or greater than 12 months. It doesn't always have to be 12 months. For example, a construction company would most likely have an operating cycle that is more than 12 months because it takes them time to deliver their obligations to their customers. The common types of current liabilities include trade payables, financial liabilities, accrued expenses, and deferred income. And I'll explain some of them, and some of them I already touched on previously. So, trade payables would be what you owe to your vendor for purchase of goods and services. So there will be the unpaid amounts as at the balance sheet date of the company for what you have purchased on credit. One issue that is relevant to discussing is what is the ratio of the payables to purchases. So that's something that you look at when you are considering ratio analysis. Just with even in debtors, you have to consider it now. If you divide your debtors over your sales, what will it give you? Like, what's the ratio? Are you carrying, even if you have trade receivable, how long is that trade receivable staying? How long is it taking your trade your how long is it taking you to pay your creditors? These are crucial questions. So what I'm explaining now is not just you know what these terms mean, but to also know the implication of this amount on the financial statement. So another type of current liability that you have will be financial liabilities. So this would include short-term borrowings, current portion of long-term debt. So sometimes you can have, like, let's say a 20-year loan, but part of it is already due this year or in the next 12 months. So that current portion of the long-term loan will be classified as current liabilities. Then we have accrued expenses. So accrued expenses are expenses that have been recognized on the company's income statement but have not yet been paid as at the balance sheet date. So it would be a little different from the trade payables, because trade payables would be, most times, it would have been things you've been invoiced for them and they relate to your business. Directly to your business, but accrued expenses will be things like your wages. So if wages like salaries have not been paid as at a particular time, or you have accrued taxes or accrued payroll, payee, pay as you earn tax, or accrued pension liabilities. So all those expenses that you've incurred that are with you, you're owing, but they've not yet been paid. Or sometimes they've not yet been invoiced, but you've already enjoyed the services. Those will be put as accrued expenses. And then we have deferred tax, deferred income, which are payments received in advance for future goods or services. And, deferred income or deferred revenue can also be called unearned income. And it is what I explained before, that if a company has gotten money, but they've not yet given the services for that, like subscriptions, they've not yet given the services, they will put it as deferred income. It is a liability to them. It is an obligation. They have an obligation to provide services to the customers, and so that will be classified as deferred income. There's something that just came up now. So sometimes deferred income can also include things like gift card, and that may also be some part of what Apple has. Apple sells gift cards redeemable at its retail and online stores. The company records deferred revenue upon the sale of the card, which is relieved upon redemption of the card by the customer. And as you can imagine, if you buy a gift card and you give to somebody, the person may not use it at that point. So the company has put in cash, but they cannot recognize it as revenue yet because it has not yet been redeemed. So deferred income may also include things like gift cards. So we have non-current assets. So we've looked at PPE. PPE are tangible assets that are used over multiple periods. So most times when people are going to classify PPE, some companies will have capitalization policy. For example, even though you buy a stapler and you expect to use a stapler for 5 years, it doesn't mean that you can put it as PPE and be depreciating it over multiple periods. So some companies will have capitalization policy. The PPE are property, plant, and equipment, are tangible assets that are used over multiple periods. They may be reported using cost or revaluation method. So either you put it as what the cost is, and then you depreciate it period by period in line with what you expect the useful life of the assets to be. Or it can be included as recoverable revaluation model, but sometimes impairments may need to be recognized. We'll look at that in a bit. So investment property is property that is used to earn rent or capital appreciation and is reported using cost of fair value model. So for example, you know that there are some companies that they have their own building. You would have seen some of them in city centers, like in Lagos Island. You see banks that have their own building, but they are not the only ones in those buildings. They are renting part of it. So I imagine that one building can be classified as PPE because it's their own building, but it's also like an investment property because they are earning rent. Just one property can be classified as PPE, what they are using and what they are using to earn rent. So investment property is a property that is used to earn rent, or sometimes it is just held for capital appreciation. For example, if they're just holding a land, holding it for capital appreciation, it can be reported using cost or fair value model. So if they are recognizing and reporting using fair value model, it means that on a yearly basis, they will call valuers, come and see, oh, we have this land or we have this building, and you value it. How much is this land now worth? And then the difference will be recognized on the financial statement. Then you have depreciation. Depreciation is the allocation of cost over useful life, which we've looked at previous time. We've looked at the different kinds of depreciation, but we also have impairment. So impairment is when the asset's recoverable value is less than its carrying amount. And recoverable value is the higher of an asset's fair value less cost to sell and its value in use. Let me explain like this. I had spoken about the land in Maitama that I said, oh, this land was worth 10 million and then they value it and it's worth 12 million. It's also possible that you can go and value that land and or the building or whatever it is, and then see that this thing that was worth 10 million because of some crisis in a particular area, it is now worth maybe 8.5 million. And if the value of an asset that is held at fair value reduces, then you would have to also recognize an impairment on that asset. So can recognize depreciation or you can recognize impairment. Impairment reflects a decline in the value of an asset. So we have different valuation models. Cost model carries assets at amortized cost, which is like historical cost less the use like depreciation of the asset. So for example, PPE can be carried at cost. It will just be amortized every period, and then revaluation model uses fair value to recognize the value of the assets. So we have cost model and we have revaluation model. Cost model is the historical cost less some use of the assets, and then revaluation model uses fair value. Most times, fair value has to be done, or like in practice, it usually would be done by a third party. So let me just look at question. Let's see if we have any question on the. Okay, question. So we'll look at non-current liability now. Non-current liabilities are long-term financial liabilities, and we have loans, we have notes, we have bonds. For example, we had seen previously that in the Apple financial statement, we had borrowings, they had I think it's called the term debts. They had financial liabilities, and then they have bonds. Some companies will issue fixed income securities to investors, and these investors are expected to repay. These investors are expected to be repaid in the future. So these liabilities, like bonds that are issued by a company, are usually reported at amortized cost on the balance sheet, but sometimes they can also be recognized at fair value. So I would quickly speak to inventory now in more detail. So we had looked at inventory, and I had mentioned that inventory should be recognized at the lower of cost and net realizable value. What is included in the cost of inventories? It includes the cost to purchase. Now, this is important because this is potentially, let's say, what companies can use to hide some expenses. So that's why it's important to know what the cost of inventory includes. So the cost of purchasing the inventory, the cost of conversion. So conversion will be if you're a chocolate beverage company and you buy cocoa, you have to convert that cocoa to chocolate. The cost of conversion, that's part of it. The cost incurred in bringing the inventories to their present location and condition. That's the transport cost of those inventories. The also storage cost of finished inventory and abnormal costs due to waste are typically treated as expenses in the period in which they occur. So it's important to know the distinction between those ones that can be capitalized as inventory and those ones that has to be expensed. If the storage cost of finished good, it has to be expensed. Inventories are a major factor in the analysis of merchandising and manufacturing companies. There are some companies where you see that they hardly even have a lot of inventory. Let's say, for example, a bank. What sort of inventory would a bank have? Maybe they will have papers, checkbooks, and the rest of that. They will not have much inventory. But if you're talking about a car manufacturer, for example, they would have huge inventory. So it's important to consider which company you're analyzing and how much do they sell, do they generate their sales and profit through the sales of inventory. If they do that, then it is important to consider how what method they use to recognize their cost of sales. Now, there are three inventory valuation methods. One is first in, first out. The other is weighted average cost, and the last one is specific identification method. Let's see if I can get a pen. Okay, I can. Okay, so first in, first out means that assets would be valued based on the cost that they have. So let me just use an example. So let's say that we're a car manufacturing company, and we bought 12 cars at $100,000. We bought 12 cars at $100,000. Then after some time, we now bought another say 5 cars at $120,000. Now, first in, first out means so this is what I've got. The units and this is the unit and this is the cost. Now I'm selling 10 cars in this year. First in, first out means that the cars that will go first would be this one out of this 12 units. This is what will go. So what will be left at the end of the period will be 2 cars here and 5 cars here. And if you want to now value this inventory at the end of the year, we'll be having 100 times 2 because we have sold 10 out of this 12. So we'll be valuing this inventory as 100 times 2. That would be 200 plus 120 times 5. That would be 600. So now the value of this inventory as at the end of the period will be 800. So first in, first out assumes that you are selling the first inventory that comes in. But if you're going to use, so that's FIFO. If you're going to use LIFO, it means that you're assuming that you are selling the last one that comes in first. And so you're wondering, why exactly would you even sell the one that comes in first? It seems like a counterintuitive method. So I'd say that this is the inventory value. Um, so if you're going to use LIFO, what you will be using instead is, so I said this is what we bought. We bought 100 cars at 12 units, and if we're using LIFO instead, what you'll be selling is, let me put it here, you'll be selling five. You first sell this last one that came in, which will be 5 units. So what will remain here will be 0. And then you sell 5 out of here. What will remain here will be 7. So how much would the inventory be worth at the end of the period? It will be 100 times 7. So the inventory value of the company that decides to use LIFO would be 700. So you see how the choice of the inventory valuation method affects the value of a company. If you use FIFO in this method and you sold 10 cars, the value of your inventory would be 800. If you use the LIFO, the value of your inventory at the end of the period would be 700. And so in comparing companies, you have to wonder what exactly is the what exactly are they using? And then eventually, like with CFA, you would learn how to standardize. I don't want to go too deep into inventory right now. It's a whole topic, but eventually you learn how to standardize and how to ensure that when you're comparing a company that is using IFRS and they are accounting using FIFO, you know how to compare it properly with a company that is using US GAAP that allows for LIFO. Now, it's also important to know that because the inventory here is higher, the US GAAP people, US companies would use LIFO method because of potential income tax savings. As you can see, their inventory is lower, means that their cost of goods sold, their cost is higher. So that because the cost is higher, it means that their profits will be lower and their taxes will be lower. So where I wonder why exactly will people use LIFO method is because of this, the potential income tax savings. That's why people would use it. So let me see if I have any question on this. So the choice of inventory methods affects the financial statements and any financial ratios that are based on them. And so it's important to know this when comparing companies. So we'll just see if we have any. Okay, so we have. Sorry, I'm trying to. I think this writing is. Okay, so it's like I need to. Let me clean this. While we're here, can you please answer these questions? Debt due within 1 year is considered. Let me see. Okay, so we have the results are in. Debt due within 1 year is considered current liabilities. Yeah, so we'll go on to the last section. Financial analysis. So, financial analysis is the process of evaluating a company, a project, or a transaction to determine their performance and suitability. Why we would do this is to identify companies and projects for investment. Now, even if you are not going to be a an analyst for a company, some of these things can help you even in analyzing companies that you want to invest in. So why do we do financial analysis? We do it to identify companies and projects that we want to invest in. We do it to compare performance with other companies. And we do it to evaluate past performance. And what do we use to do this? Financial statement. That is what we use to do this. So the purpose is to evaluate a company's past financial performance, and we do this as it reflects a company's strategy and it guides future projections. Now, there are key questions that you need to ask is what are the changes in the profitability? That's the net income, the profit or the loss. What are the changes? What are the changes in their efficiency? How well are they using their assets? Because one company can have 2 million in assets and they are generating 200, 200 whatever, and 200,000. And another company is having 4 million of assets and they're generating the same 200,000. Which company would you say is more efficient? The company that is generating more income for the same level of assets. And that you would have seen one of that this analysis floating and comparing different banks that with how efficient different banks are with their resources. And so financial analysis helps you to compare what are the different companies that you have and which one should you invest in, which one is better, and even evaluating a company's past performance. How have they done in the previously? You know that they will always tell you that past performance is not a doesn't always show what future performance would be. Yes, but past performance can sometimes reflect a company's strategy. It can help you to understand what the company is doing, where they are going to, and it can also guide future projection. Like if they've done this in the past, if nothing changes, maybe they are capable of redoing this in the future. So some of the things you look at is when you're analyzing is what do the level and trend in a company's profitability, their efficiency, their liquidity, and their solvency, how does it compare with the corresponding results of other companies? Because is 20% good enough, or are there other companies in the same industry that are getting 40%, meanwhile your subject company is getting 20%? So it's when you have, and that's the beauty of using ratios. When you use ratios, you can compare two companies. But as I've said before, you have to be careful because differences in financial standards and how they recognize can also affect this ratio. Okay. So you also consider what aspects of the performance are critical for a company to successfully compete. And to do all of these things, just before I go to the next slide, to do all of these things, what do you use to analyze? You use your financial statement, that's the company's financial statement, industry report, some analysis, some research companies will have industry reports, and sometimes you can use that. You can use macroeconomic forecast. For example, you can look at a stable company and just say, oh, I expect that this company, because it's stable, it has been here for the past 20 years and they grow in line with population and demand. So we can expect that the increase in this company's revenue would only increase in line with maybe inflation or GDP growth. So some in doing financial analysis, you can use industry report, macroeconomic forecast, um, approach. There are approaches that you can use to do financial analysis, and we'll look at that in more detail. Cross-sectional and trend analysis, can do ratio calculations, and industry-specific metrics. As I've said before, for example, while a construction company, inventory ratios will be very important to them. A bank would not need inventory ratios. What inventory ratio would they have? While some companies will have, like a retail company will have quick inventory turnover because as they're buying, they're selling. And you can compare different retail, maybe you can compare ShopRite with Tesco in the UK and maybe Lidl in Germany, but you cannot compare those ones with a construction company. So when you're comparing, be careful of the companies that you are comparing with, that they are actually competitors, they're actually in the same industry. So key analytical questions that you would ask are how and why have corporate measures of profitability, efficiency, liquidity, solvency changed over the periods being analyzed? It's not enough to just say they have changed. We also need to know why they have changed. How do the level and trend in a company's profitability, efficiency, liquidity, and solvency compare with the corresponding results of other companies in the same industry? And what factors explain any differences? Is it management? Are they managing properly? Do they have a better brand? Do they have a better customer list? So you have to even know what factors explain any difference that you would see. What aspects of performance are critical to for a company to successfully compete in this industry, and how did the company perform relative to those critical performance aspects? And as I'm mentioning this, I want you to think about, for example, hypothetically thinking about companies that you may want to invest in, and think if you're investing in a company, what would you consider? These are the things you consider. If you're evaluating the past financial performance of the company that you work in as an accountant, what should you consider? These are the things. If you're comparing companies, these are the things that you consider. Then you look what aspect of performance are critical. For example, for a retail company, the what is important for them may be their negotiation power with the suppliers days, if they're able to push as much as possible to get favorable suppliers terms, and if they're able to get their debtors to pay as early as possible. What exactly is, like, or is it their location that is their winning power, is helping them to be able to perform more than the other companies? So you have to also understand the why as you are analyzing a company. So what are the company's business model and strategy, and how did they influence the company's performance as reflected in, for example, its sales growth, efficiency, and profitability. And I've mentioned before that you have to understand the company before you actually look at financials. And I know this is something that it's just easy for us to just jump into. You want to analyze the company and then you just jump into the financials. But before you do that, you have to understand the business model. Where do they get their money from? And some of you remember when we looked at this Apple financial statements, we saw that the revenue is primarily generated from two sources, product and services. So and we now checked services as a percentage of total revenue. How has it compared? Because I wanted to see if there was a change in strategy. And you see that it was about the same thing. It was almost similar. So for some companies, you see like a vast decrease. Maybe they have sold an arm of the company that was lucrative. So these are things you need to do. What's their business model? Where do they get revenue from? Where do they sell their revenue from? What's their location? What platform do they meet their customers in? And how does all of this affect their sales growth, their efficiency, and their profitability? Okay, so I just want to read an example. A change in product reflected in financial performance. Apple is a company that has evolved and adapted over time. In its 1994 prospectus, Apple identified itself as, that's 1994, that's about 30 years ago now. Apple identified itself as one of the world's leading personal computer technology companies. Today, can you see Apple as a world-leading personal computer technology company? Today, you see them as a phone company. And then in 2005, an article said in the last year, the iPod has become Apple's best-selling product, bringing in a third of revenue. But even today, like how many people have iPod? And then that was in 2005. By 2007, Apple entered the mobile phone market, launched iPhone, and then in 2008, it launched another iPhone. By 2009, Apple was the world's largest music distributor, passing Walmart. So it's important in analyzing revenue, for example, you would have seen a stark difference between 2005 and 2009, where they generated their revenue from. And so financial is not just about the numbers. And if you're a financial accountant, you have to be telling a story. What does this financials mean? What kind of story does it tell about your organization? So, next one. Okay, so I want to talk about two, and I'll dwell on this for a bit. Two parts, two applications when you're evaluating past financial performance. One is projection of future financial performance, and this is used to determine the value of a company or its equity component. So you may have seen a company that generated revenue of any amount last year, and then you want to project next year performance. Why would you want to do that? The reason is usually we want to value a company. And I think I saw somebody in the chat box that said the person did one financial modeling and valuation course. So in valuing a company, you want to have what is the free cash flow? How much can this company generate in the future? And so while free cash flow will mostly be used like you work back from income statement, which is outside this course, but for the purpose of now, we're just going to look at the cash flow statement. And so you'll be looking at something like the cash generated by the operating activities minus the cash used in investing activities. Here will be 122 minus 22. That will be like their free cash flow, just simplifying free cash flow. So this will be the amount that is available for the shareholders, or the both shareholders and the debt holders to use. And now we know what that is at the end of, what's the period? At the end of 2022. At the end of 2022. But say you have to forecast these financial statements to the future. Who can give me an idea of what do you think we'll do if you have to forecast? Okay, so if you have to forecast in the future, what you can do is you can assume that the revenue will increase by a particular percentage. I'm just looking for where the revenue is. You can say, okay, we assume that total net sales will increase by 10% because we expect global economy or Western economy to increase by 10%. And so by the time you forecast all of those, you can now be able to arrive at what you think the free cash flow would be for the subsequent period. So the reason for evaluating past financial performance is because when you understand how a company has performed in the past and what has driven their performance till date, you can now be able to forecast to where you think that they will go in the future. Thank you, Mui and Ejo. You can, when you understand what they've done in the past, to help you to be able to forecast where they are going to in the future. And usually you need this, maybe you want to forecast their value in the future, you want to get their equity value in the future, or you need it for credit analysis. As we've explained previously, like a bank would need your financial statement, and then you'll be looking at what is your free cash flow. How much do you have to be able to, after you've settled, after you've invested, how much do you have to be able to pay your interest? Do you have the money to be able to pay your interest? So those are the kind of things that they would be looking at. Projections of future financial performance are used in credit analysis, particularly in project finance or acquisition finance, to determine whether a company's cash flows will be adequate to pay the interest and principal on its debt, and to evaluate whether a company will likely remain in compliance with financial covenants. Just by the way, financial covenants sometimes, like if a bank wants to loan a company money, they can say your free cash flow over your interest, for example, should be able to cover your interest like 10 times. Just like if you want to borrow money now, they'll say your income should be like 3 times your repayments, something like that. So that kind of thing also applies to companies when they are when they want to borrow, and they would have to meet particular kind of covenants. Credit analysis uses financial statement analysis to evaluate credit relevant factors, including the tolerance for leverage, operational stability, and margin stability. So a company wants to know how stable is this. A bank wants to know how stable is this. Can I expect to recover the money that I am given this company? Now, just to mention that in using historical performance, because we had said that you can use past financial performance to forecast the future. So I want to give you 3 examples of a company, and then I want you to tell me which of the companies you think you can use their past performance to justify to forecast their future operating profit. So one will be Johnson and Johnson. Johnson and Johnson, this US healthcare conglomerate founded in 1887, had 2017 sales of around $76.5 billion from its 3 main businesses. So they had it from pharmaceutical, health, medical devices, and diagnostics. Medical devices and diagnostic and consumer products. So we have Johnson and Johnson, that's one. We have BHP, which is a company that deals in natural resources, incoming miles, coals, iron, copper, and also has some substantial petroleum operations. And then we have the third one, which is Baidu, is a Chinese company that is the leading Chinese language search engine. The company's revenue for 2017 was 84.8 billion renminbi, which is an increase of 20% from 2016 and almost 4 times the revenue in 2012. So I've given you 3 examples. Johnson and Johnson, BHP, which is a petroleum company, and Baidu, which is a Chinese company that has substantially increased its revenue in the past 4 years. So which of these do you think that you can use the past performance to judge the future, that's the past operating margin to calculate for the future, to project for the future? Let's see answers. And if you think you cannot use it for the others, you can just tell me why you think you cannot use it for the other companies. Okay. Thank you. So I like the I like the conversations that are happening. So it says Johnson and Johnson, mature industry, stable cash flow, except black swan like COVID. Thank you. Like so true. You can use the past performance, the operating margin. So if you want to compare, you look at it, it's a stable company, and then use the operating margin of the past. So John Ayodele said BHP can't be used due to volatile commodity prices. Yes, so true. BHP deals with iron, copper, and the rest of that, and petroleum, and because those prices can fluctuate period on period, it may be difficult to use the operating margins of the past period to judge them in the future. And then Beijing technology companies, yes. And like your responses are so spot on. Thank you, Moyin, John, Daily Ejo, and one again. Since technology companies are fast growing and geopolitically volatile, if Chinese. So because it's a company that is a technology company and it was just established, and I mentioned that the company had grown significantly in the past 4 years. So you may not be able to use the the past operating profits to forecast into the future. So for a company like BHP, if you were going to be analyzing BHP for the future, what you may be looking at is to look at, we mentioned it before, and now is the practical application of it. You may be looking at, are there industry reports that was talk to how they'll talk to how this bit they'll talk to how you what you expect them to earn in the future. For example, what do we forecast petroleum prices to be in the future? If you're going to be analyzing BHP, that's probably something you'll be looking at. So you'll be looking at the future. What are industry experts saying about the future of these companies, instead of just relying on what their past performance has been. Thank you, Joseph. Said approach to financial reporting, consistency and reliability of reporting will also be what we have to consider. Yes, so thank you for that. So in forecasting a company, sometimes we use a percentage where you just say, okay, we expect it to be $100 this year, and then in subsequent period we expect it to grow by inflation rate, we expect it to grow by 10% or something like that. And with that, you can be able to forecast into the future. So we'd look at the last subsection. Sorry, just before we look at that, let's look at this. So in analyzing financial performance, there are three kinds of analysis that we do. One is horizontal analysis, where we compare growth trends across time periods. That's analyzing revenue for example, analyzing revenue for 5 years. We are looked at, like you see where we showed Apple income statement and we saw for 3 years. That would be horizontal analysis or time series analysis, analyzing across different periods. And while vertical analysis will be comparing one item on the financial statement to a base item. So some of us will have seen it that we did common size analysis. So that's also called vertical analysis, where you compared one item as a percentage of another. So you see, like operating income, that's the net profit as a percentage of sale. That would be vertical analysis. Then you can compare. We looked at cross-sectional analysis that will be comparing different companies over time. Now, vertical analysis is the type of ratio analysis, and we use ratios to analyze a financial statement. Ratios can be compared with different companies or across the years. You can do what's the current ratio, that's the current assets to current liabilities. You can compare it over the past 5 years for one company, or you can compare it for different companies. So ratios, so look at screening potential equity investment, and ratios constructed from financial statement data and market data are often used to screen for potential equity investment. So we have different kind of ratio. You can see what's the, for example, dividend to market value ratio. That's how much dividend, what's your dividend yield, dividend over the market value of a company. You can have current ratio. You have different kind of ratios. So ratios can be constructed from financial statement data, and I just mentioned now dividend and market value of a company. So that you may not see that in financial statement, but you should be able to get market data, and then you use that to screen potential equity investments. So what is screening? Screening is the application of a set of criteria to reduce a set of potential investments to a smaller set having certain desired characteristics. So screening is basically just applying a criteria and saying, okay, I want to take, I want to look at stocks that the dividend yields are above 8%, for example, something like that. That would be screening. Criteria involving financial ratios generally involve comparing one or two more ratios with some pre-specified target or cutoff value, which, as I just mentioned, you may decide that your dividend yield that you're interested in is 8%, and you only invest in companies that dividend yield is over 8%, for example. Okay, so security selection, sorry, not security selection approach incorporating financial ratios may be applied whether the investor uses top-down analysis or bottom-up analysis. So there are two kinds of analysis that people do in selecting potential equity investments. So top-down would be somebody goes and says, where do I want to invest in? For example, oh, okay, I want to invest in, let's say, Asia. And then which industries in Asia do I want to invest in? Technology. And then which from technology now, I can now screen technology companies in Asia and decide the ones I want to. That'll be top down because you're coming from the top industry or geographical area, and then you're going down to look at companies that meet the criteria. Or you can do bottom-up analysis where it involves the selection of specific investment from all companies within a specified investment universe. For example, you're just saying, okay, all the companies in Nigeria, I want to invest in them. I want to choose companies, and then I only want to invest in companies that like I mentioned, the dividend yield is this, or I want companies that have their value, their relative value is low based on compared to what I expect the company to be able to yield in the future. So you can also use that kind of bottom up where you select specific investments from all companies within a specified investment universe. So screens can be used by both growth investors, value investors, and market-oriented investors. Excuse me. Okay, so screens can be used by both growth investors, value investors, and what we call market-oriented investors, which is intermediate between the two of them. And we'll just look at what each of them means. So growth investors, and some of us may have heard growth investors. What are growth investors interested in? High earnings growth companies. As companies that you look at that there's potential for them. And I'm going to give you an example, and you tell me what you think it would, which kind of investors would be mostly like interested in them. Then so companies that you look at and you see they have high earnings growth companies. For example, all these hedge funds, all these private equity companies, they'll be interested in high earnings growth companies. Value investors are focused on paying a relatively low share price in relation to earnings or assets per share. So they're looking for what's the share price compared to the earnings or the assets of the company? They want to get a deal. And most times, value investors will focus on companies that are already established, like we had mentioned, G and G. We want companies that have been there for a while and they just want to get a low price for those investments. And then market-oriented investors, they are an intermediate grouping of investors that whose investment disciplines cannot be clearly categorized as value or growth. Now, if someone can just tell me where do you think, if you're investing in NVIDIA, where do you think you'll fall? Growth, value, or market-oriented screening? NVIDIA is an AI company. Okay. So growth, because that's the kind of company that you expect that the um, growth or in the future they will have high growth. Why they are not value? Because you see how it talks about low share price in relations to their earnings or asset per share. They probably don't have any earnings or any significant earnings at this point. So anybody interested in all this, so anybody interested in all these companies that are just starting up will most likely be growth investors. Now, an analyst may want to evaluate how a portfolio based on a particular screen would have performed historically. For example, somebody can say, oh, I want to invest in this kind of companies using these criteria, the ones that say, oh, if the EPS is above this, if the EPS is earnings per share, or if the earnings per share over the market price is this, like you just list all those criteria. If I want to invest in them going forward. However, I want to go back, to see if I had invested using this criteria 10 years ago, what would it have given me? So that is what we call backtesting. And backtesting applies the portfolio selection rules to historical data and calculate what returns would have been earned if a particular strategy has been used. And there's something to note that backtesting can have some, let's say, challenges. Backtesting can have some challenges. If you go to the back and go and test, there are companies that probably no longer exist. So you'll be having a better than normal results because there are companies that they no longer existed. Meanwhile, let's take for example now, you go back and you say, if I had invested in 2020, sorry, 2000, and I had used this criteria, what would I get today? If you go back and you use that universe of securities that exists today, you may have in 2000 actually you would have invested in some companies that would have failed in 2008 crisis. So it's important that when you're going back to test, you know the limitations, that some companies no longer existed, so you'll be having a better chance. Your hypothetical result will be better than if it was actual, because if it was actual, you would have gotten a lower result. If the database that you're using in backtesting eliminates companies that cease to exist because of a bankruptcy or merger, then the remaining companies collectively will appear to have performed better. Then another bias that happens where you are backtesting is that there's survivorship bias. That's if the database used, look ahead bias. That's now from where you stand, you're able to have the benefit of insight and say, oh, if I had known, then this is what I would have done. But there are certain things that would have happened. If you had invested in 2000, there are some financial statements that probably changed now in 2024. You're looking at 2020 account and you say, oh, okay, it's good. But some companies probably restated their financial statement and corrected their financial statement. Who said that you wouldn't have used, if you were investing in 2000, you wouldn't have used those wrong financials or those on the previous version of financial to make your decision. And so there will always be that mismatch between what you would have actually known at the period you would have made that time investment decision and what the information you get now in backtesting. So it's important to know that you would not have known that the benefit of hindsight, you would have not known those information. And then there's something called data snooping bias, where you build researchers build a model on the basis of previous researchers' findings and then use the same model to test that model. So it's a loop. You you're building a model based on somebody's findings, and then you're now testing the same thing. You will arrive at the same answer because you're using the result of that model. If somebody has built model and said, oh, this based on what you have seen, if you use this criteria, you would actually get superior returns. And you go back to go and test, you're going to get the same thing. But the most valid way of actually knowing whether you're right is to go to the future and test. Now, what we know today, based on what we have seen in the past, would it be applicable in the future? And so it's important to be aware of these biases because sometimes in investing or in analyzing for investment, it's very easy for us to think that, oh, we should have known or I'll make mistakes and just go and refer back to what was there in the past. And so here you have it with screening for potential equity investments. I know that in this class, I have not covered everything in FRA. I've just tried to focus on the background, those things that I hope that if you understand the basis of them, you would be able to you'll be able to have a solid foundation and it will give you, I hope this also gave you a good understanding of what you can expect to see in FRA. FRA, as I said, is about financial statement, analyzing financial statement, some of things that we've not covered and here and would go into detail during the lectures or during your reading for CFA level 1 would be like looking at adjustment. How do you adjust? Like that example we saw comparing FIFO and LIFO and you're having inventory. If you're actually analyzing companies that have different methods, how exactly do you, what adjustments do you need to make to be able um, to compare a company that uses IFRS versus a company that uses US GAAP. And so I'll say this would be the end for now because I know that we wanted to ask questions. I don't know if think we can stop recording. I don't know, but if we have any questions, so if we have any questions, maybe we can start from questions on the FRA and we can go to general questions on CFA. Any questions? Okay, so Bisola has a question.
All right. Good afternoon, ma'am. Good afternoon, everyone.
Good afternoon.
So my question is actually not on the lecture, but
Yeah.
on CFA
Okay.
generally, because I've kind of during the break I went to check you up on LinkedIn and I saw a lot of things about you. I mean, your journey through CFA and the rest. And I noticed at the point you said you actually focus on the CFA curriculum. And even there was a time that you tried to like get other resources. It wasn't really working out, so you had to go back. So now my question is that, is it advisable that you try to read up all the curriculum? I know that what works for someone may not actually work for another, but the reason why we have experience is that so that it can also guide us on what can also work if we try to implement that. So what is your advice going to be? Is it that we should just focus on finishing and understanding all the curriculum, because it's quite bulky? So that's my question. Thank you. And I'm so proud of you. I'm so proud. It's kind of motivating, and it's giving me the kind of you can do it view. So well done, ma.
All right. Thank you. Thank you so much. So I'm not muted, right? You can hear me. Okay. So
Yes.
okay. So um I see that there are some questions in the chat box. So John, I'll come to that in a bit. But concerning what you should read for curriculum or other materials, I would say it depends on your learning style. Now, I think most of us here would have at least had 2 years of university, even if you are not finished, because for you to write CFA, you would have had to finish. I think you have to be your third year before you register. So you already have an idea of how reading is for you and what materials you like, which kind of lectures you like, where you have the where you have challenges. For example, I knew from writing ICANN that whenever a course is um, theoretical, I usually struggle with it more. I prefer something that's practical that I can apply. So I knew that if it had got to ethics or all those more abstract, I had to apply myself more. So just think back about what you know about yourself. And I'm not saying that if you think that you always struggle, you always struggle, because you can change it. It doesn't have to always apply. But it can just give you a guidance as to how to ensure that you maximize your strength. So for me, curriculum was the best because I started studying all the summarized version um, of those summarized CFA version, and it did not work for me. It was too dense. Like I do not understand. So I I knew that my option would be reading the full curriculum, and I read everything. And I had to be very detailed about tracking, and because I think it's about 3,000 pages for level one. So that means for level one, two, three, I read almost 9,000 pages. And because level three was cancelled during COVID and I had to read it again, that's definitely above 9,000 pages that I had to read. So knowing what you know about yourself, and what I usually advise is that people start studying early so that you can have that freedom to try and change your methods. So try something, and if it doesn't work, you can always see, okay, I've tried this thing. is not working. How can I change it? No, and that's why it's important, like to understand, to hear from different people so that you say, okay, this person method worked for this person. Maybe it will not work for me. Like it will not always work for you. Not everything would work for you. For example, I don't like studying overnight. And it's important for me to see people that, okay, there are other people like me who will not actually find it interesting to study overnight. And so just try different methods and find what works for you. Think back to what has worked for you in the past and just apply it. I hope I answered your question.
Yes, thank you. Thank you for your response.
Okay.
Thank you.
Yeah. Um, somebody had asked me about I should go through the tax savings on FIFO and LIFO. And while I'm looking at that, like if you have any other question, you can. Who is it? You can just put it in the chat box. So I was explaining this inventory, and let me try to. So I explained if a company has 100, I remember the total 112, and then they have another, they bought cars, 12 cars at 100,000, and then bought another five at 120. So let me, I had calculated the inventory previously, but let me even calculate it based on cost of sales. Because they are selling 10 cars, the company that is selling 10 cars, their cost of sales will be 100 times their cost of sales will be 100 times 10. So that will be 1,000, because it's the first thing that goes first out. So 100 times 10, that will be cost of inventory. Then if you're using LIFO method, your cost of sale, and you're selling 10 cars, it's still the same 10 you're selling. But instead, what you'll be doing is you'll be going from, sorry, I, okay, you'll be going 120 times 5, that will be 600, plus the remaining 5 is going to come from the first, because you have sold the last, from the last batch, and then the first batch is where you now be doing the next 5. So the next 5 is going to come from the first batch, which will be 100 times 5, which will be 500. So the cost of sales for LIFO method will be 1,1, while the person who is selling with FIFO method will be having cost of sales of 1,000. So if we say that car, actually they sold it for 200,000 and they don't have any other expenses, so their revenue will be 2,000. Both companies, their revenue will be 2,000, and the profit for the company that use FIFO method will be 1K. Meanwhile, the profit for the company that use LIFO method will be 2,000 minus 1,1, will be 900. So you can see that the LIFO method actually results in lower profits than the FIFO method, even though it's still the same amount, everything was the same. It's only the method that they chose. And so this person will be paying less tax because the person has um, lesser profits. John Ayodele, do you understand? Okay, yes. So does anyone have any other questions? CFA on this financial reporting? Okay, somebody says, can you share tips on how to smart the L1? Okay, so share us tips. So one of the things that people always ask is, how do I ensure that I pass this at one sitting? Like I don't want to rewrite it. And I would say one is like, how bad do you want it? And something like, how much do you really want it? What are you ready to dedicate to having it? Then, one thing is also to see people that have passed. Like, what did they do? One thing you need is solve past questions. You need to solve past questions. To me, I think you should solve at least 10 practice questions, and that's based on the research I've done, and I've seen that people who practice 10 or more, although at some point it starts declining, but they usually tend to pass. So finish studying. One is start studying early, finish stud finish studying early and solve as much practice question. And of course, one of the ways you can actually increase your chances is if you know that you would benefit from people already explaining it from you, explaining what you need to know. Of course, you can join New Frontiers, and you already have teachers that will simplify it and would follow it. So it's a way to make yourself stay disciplined. Um, for me, I'll say the most important thing was reading and having a set timetable. This is what to read when, dividing it, ensuring that I had enough time, plan ahead. If you know that you have a job that is that you can get busy um, at up to any time, um, plan ahead so that you can cover syllabus. You can study as much past questions as possible. And I think that if you do this, you increase your chances. For me, the way I looked at CFA was I am increasing my chances to pass, not even just on. I'm going to do everything to ensure that I increase my chances. So you increase your chances when you start studying and you study everything that you can study, and then solve as much past questions as you can. Um, and actually, I'll just put my name on LinkedIn because I wrote an article. Now I cannot get the link, but I wrote an article and it's linked somewhere um on my LinkedIn. So I like, did a 3 parts article on passing for CFA and all the information that I got. If you can't find the link, you can chat me up and I'll look for the link and send it to you. Unfortunately, I don't have it here, but I believe that it can help people. If you still have other questions, you will see that a lot of your questions will be answered in those articles. So, any other question? Yeah, this one I said yes. I saw the article on LinkedIn. Okay. Do you have any other question?
Thank you so much, Ma. Are you going to share these slides or something?
I think I'll give it to New Frontiers and they will decide it. But yeah, I would send it to New Frontiers and they should be able to send it to those who registered. Okay, so
Sorry, good afternoon.
good afternoon.
Thank you, Joy, for an excellent presentation there. But my
Yeah.
own concern is I know how do we are we supposed to just share our email addresses and then we get the presentation or how is it going to happen?
Let me check with the New Frontiers Learning Team. They can just confirm if they have all the email addresses of people who registered and they can send it to them.
I never registered. I've always been on their platform. I guess that's why I got the invite
Yeah,
and
okay.
or the notice and then I joined.
Except, sorry, I can't even see. Except if you chat me up and I can try to send to you, but I'll see if I can send to. Okay, so New Frontier said, yeah, they'll email the materials to everyone. Yeah,
Well,
but
okay,
if you
excellent.
still
Thank
don't
you so
get,
much.
yeah. Yeah.
Thank you.
Sorry, like it's not showing me who is speaking, and so I can't even see names of people that
Okay,
are
my name is Olumiwa Adeyemi.
okay. Okay, thank you,
Yeah.
Olumiwa.
All right.
So in the absence of any other question, I think we would be calling it a day. And if you have any question, you can contact New Frontiers or you can chat me up and I'll try to answer. So, so that'll be all for now. Thank you and have a nice day and enjoy your CFA journey if you decide to go ahead with one.
Thank you.
Yeah, thank you.